All righty. Well, I am Wes Barclay, and I will be teaching this course today. We are doing a VA course. So this is a great, probably my favorite one. Somebody asked me the other day, what's your favorite course to teach? And it's VA because VA is my favorite program. So anyway, I'm going to see if I can share my screen here. Where is it? Share screen. And sure. Okay, let's get into VA. Okay, guys, can you see? Are you seeing what I'm the VA thing? Can you give me a thumbs up if you're seeing the VA course? You can see it. Good, good. Go to view, dismiss, and present. Oops.
Good morning, y'all.
Good morning, sir. Okay, we're starting the class right now.
Okay, I'll mute.
Okay, great. Well, again, my name is Wes Barclay. I am with Homestar Financial. Today's course is VA loans, what you need to know as an agent. So just a little background on myself. So I am an MLO with Homestar Financial. I've been doing this for about 20 years, and I was actually an underwriter for a lot of those years. So about 7 years I was an underwriter, and some at Wells Fargo, and then 2.5 at Homestar, and then I moved into originating. I'm a husband of 15 years, and we have 5 children. So so basically what I have to do is I have to find a deep place in my basement here so that I can have some peace and quiet, because we also homeschool all of our kids. So lots and lots of kids. I also coach baseball, and I'm the youth, the 7th grade boys youth leader at my church over in Kennesaw, Georgia. So exciting times. Clearly, I enjoy working with the youth, and I really enjoy teaching too. So this is good. I always enjoy these classes. So in this lesson, what are we going to go over? We're going to go over the history and significance of the VA program. There's a lot of history behind the VA, and it was meant just kind of as the VA tries to do whatever they can for their people, knowing that they've fought for our freedom, and there should be perks for that. So some of the current issues, the misconceptions that there is, myth versus fact, and why it's the best loan available. And I truly believe that VA is the best loan out on the market today. The problem is you only qualify it. Only a small percentage of people qualify for it. So, okay, 3, veterans eligibility and entitlement. We're going to go over the certificate of eligibility. We're going to go over the proof of service requirements, so the DD-214 and the statement of service, and then restoration of previously used entitlement. So let's keep going. So the VA loan and guarantee, basic elements of the VA guarantee loan, the maximum loan amounts and guarantee. And when we get into the guarantee, I'm going to try to break it down a little bit. It's a little tougher not having like a whiteboard or anything to write on, because I like to give examples of things. But we've got some examples in here that I can kind of, that I'll be able to use. It's kind of built into the slide. I just also like having the whiteboard too, but it'll be okay. And then occupancy, what constitutes as an owner occupied property, and interest rate and discount points. The credit underwriting. So we'll go over the income and assets. We'll go over the taxes and deductions from the income, debts and obligations, and the credit history. I think there's a way to, 1 second, I'm going to, okay. How lenders process VA loans. So submitting loan documents to VA, and then prior approval procedure. Special consideration. So loans requiring special underwriting, guarantee, and other considerations. Then we'll go with the fees associated with the VA loan, borrower fees, lending charges, VA funding fee. We'll go over property eligibility and identifying property eligible for VA loans. the appraisal requests and considerations, and the appraisal requirements. Minimum property requirements, repair issues, the appraisal reasonable value if different from the sales price, neighborhood association considerations, common interest communities, condominiums, and planned unit development. And then we'll look at the sales contracts too, the VA loan exhibit. This is something that's going to be real important for you. And pre-approval letters. So loan commitment letters, agent roles, borrower lender example. So then we'll kind of get into a little bit of role play, giving some comparisons with VA loans and then with other loans. We'll get into the loan worksheet, the sample transactions, and how to inform buyers of the program and what questions to ask to find out if your customer is VA eligible. So listing of VA offices, we'll list that too. So yeah, any questions about anybody? If you want to unmute yourself, if you got any questions, definitely don't hesitate to stop and let me know. Q&A. Okay. All right.
Just want to let you know, FYI, I am a veteran, so if you want to use me as an example, you can.
That's great. And this is John, is that right?
Yeah, John.
All right, John, I appreciate you, sir.
Okay, no problem.
John, have you ever done a VA loan for yourself?
I have not, because when I remarried 8 years ago, my wife wanted to go 20% down, and I couldn't argue with that.
Sure.
So.
Sure. So I'm going to ask you in a little bit here when we start getting into it and the benefits of, even if you're putting 20% down, sometimes it's still beneficial to do a VA loan, believe it or not. But I think you're going to be surprised about some of the stuff you can do with the VA loan. Most veterans don't even understand like the full capacity of what is allowed. So, okay. So it was originally conceived in 1944 to help with the aftermath of World War II. Only available, it was only available for a short time after the war, and you know, it was reestablished with the Housing Act of 1970. In 1974, made the program a whole bunch more viable. So it was a little bit more difficult to get to. The Housing Act of 1974 made it available for a lot more veterans. And then it rolled back some of the constraints that limited our service people the ability to use the program. So again, they started off just trying to help veterans out, and then it kind of realized, hey, we got a good thing here, and let's see if we can kind of open this up and see if we can't extend it to more of our men and women in the military. So misconceptions and myths. A lot of people think that you can only use a VA loan one time. That is absolutely a myth. If you had a foreclosure, you're not eligible. That is absolutely a myth. And a lot of people think that you have to have perfect credit to use the program. Also not true. And then a lot of people think that you can't own other houses and then get a VA loan. Well, that's not true either. So a lot of the times people get confused with other products. So that last one, they're thinking USDA. USDA, you can't own another home that's habitable. But with the VA, they don't care. You could have 10 homes if you want to. The more thing is how much eligibility you have, and we'll go over that in just a little bit. Appraisals take forever. Well, that's not really true either. They take about the same time. Now, the appraisers can be a little bit a pain because they know they work for the VA and that we have no leverage over them whatsoever. They're going to get the business no matter what. But I find most of the appraisers don't let that go in their head. Most of them are still do a good job. You have your outliers out there, but in a general role, I have not seen a whole lot of issues with appraisals. Too much red tape for a VA to make sense. So that is absolutely not true. And I think you'll find out as we go through this that it's actually a pretty lenient program. VA takes too long. Also not true. Only have one VA loan at a time. Now, this is one that surprises a lot of people. They think that, I can only have one. I've already got a VA loan. I can't do it again. That's not true. Conceivably, you could have 3 VA loans. And we'll kind of go through the math on that in just a little bit. So there's no loan more misunderstood than VA. It's amazing to me, I guess, because I live in this world all the time, but I just taught Mortgage 101 class to a group of agents up in Gwinnett. And when I went to the VA part, they were just like, I just couldn't believe that it was like oohs and ahs. I felt like I was a rock star or something, like I was playing in the major leagues and just hit a home run. So I have to remember that, agents don't necessarily live in this world day in and day out like a mortgage person would. You're only going to know the ones that you have. And if you don't have a big VA market, you're probably not going to see this program a lot. But I think when you see this, it's going to make you change some of your perspective and maybe look at possibly marketing, especially if you've got previous VA experience, John, because I know veterans relate to their own because they know that, hey, you've been experiencing the same stuff I have. So that's why USAA has managed to maintain a large percentage of their military people, despite having much higher rates than most insurance companies. So there's a loyalty factor for sure that's very admirable quality that you see in a lot of veterans. Okay, so why VA loans are the best loan available? Simply put, there's no financing. There's no down payment required. So it's 100% financing with no monthly mortgage insurance. Now, the no mortgage insurance is a little bit misleading. So yes, they don't have mortgage insurance, but VA does have a funding fee, which for all intents and purposes is just like FHA's upfront mortgage insurance. So there's no monthly mortgage insurance. There's nothing that makes your monthly payment that goes into your monthly payment, like on a conventional where you're putting less than 20% down or with an FHA loan period. But there is an upfront mortgage, there's a funding fee that is I think it's 2.3%. We'll go over the exact number. And it's tiered based on how many times you've used it and then what branch of military you're in. So, okay, so it's extremely flexible with guidelines. A lot of people don't know that. The guidelines on VA loans are not, they truly are guidelines. And I always tell people, look, they're not exact lines, because they'll say, well, the guidelines say you can't do it from, you have to be working self-employed for 2 years, or commission. You have to be receiving commission income for 2 years. And I said, well, that's guidelines. It's not exact lines. You have to look at the full picture. You don't just pigeonhole one little thing and say, okay, this doesn't meet this rule. You look at the overall loan, and if you've got somebody who's got excellent credit, maybe some assets for reserves, then you can use common sense to justify it. And VA truly wants underwriters to use common sense to get their people approved. And I've gotten some crazy stuff in through VA loans where I just use logic and reason that I feel confident would not have worked on an FHA loan. That VA said, yeah, we'll do this. So they're a little more flexible with foreclosures, believe it or not. Bankruptcies, they're about the same on bankruptcies. And then your debt to income ratios. Not a lot of people know that that VA loans don't have a maximum DTI per se. They have guidelines, but then there's exceptions for that. They say, well, yeah, you can't go above 42 unless there's some other compensating factors in here. There's residual income, that kind of thing. And really, if your residual income, and we're going to get into this in a little bit, if your residual income is strong, you can, I think we've had one that had a 71 back-end ratio that we were able to approve because the residual income is there. And you're probably thinking, what is residual income? I promise you, I will tell you, but you got to wait. So I like to keep people in suspense, because it's we're talking about loan programs here. I know it's not quite as exciting as maybe Lost or whatever the show is, but still, it's actually, if you realize, hey, I can make some money off this, and all the while helping veterans get in the house, that's a win-win. So, okay. So why many loan officers don't know about this program? I don't know. I think loan officers can kind of get lazy sometimes. They just kind of, I shouldn't just say loan officers. I think people in general just kind of get a little bit complacent. It's not comfortable to change or to learn new things, especially when you start getting as old as I am. I'm 42 now, and I feel it when I have to learn something new. I like my body and my mind resists, and I have to just be like, nope. Okay, I need this to keep growing. So got to keep that brain and mind sharp. So no down payment requirements is 100% financing. No maximum loan amount set by VA, which is kind of neat. No income limits. So that's another thing that not a lot of people know. There's less stringent qualifying standards. multiple products. You can use fixed rate, you can use ARM, etc. Not a lot of people doing ARMs right now. I mean, rates are so low that it just kind of doesn't really make sense to do ARMs. But it's still available, and I think one day that will be a market that people will want to explore again. No mortgage insurance required. No reserves required after closing unless the borrower has an investment property, and we'll go over that. No prepayment penalties. It can be assumed by a creditworthy buyer, veteran or non-veteran. So for those of you who don't know what assumed means is a lot of times lenders will allow somebody who wants to buy the house to assume the current owner's mortgage, which is kind of neat. So that's something that I've actually had a friend of mine do when he bought a house. He just assumed the other guy had a real low rate. Funny enough, that real low rate was 5%. So it kind of shows how low rate is sort of relative to the times that we're in. Because now if I told somebody 5%, they'd think I was ripping them off. So you can forbearance extended to veterans in financial difficulty. So if the veteran ever came in and said, hey, I just got into a car accident, I haven't been able to work for 6 months, they can call the VA and they'll give them forbearance. So you just have to be careful with forbearance because sometimes that can limit you on being able to get finance for future loans. So you don't want to just be like, throwing that out there like, hey, by the way, just claim forbearance, just get the forbearance as soon as you can. That needs to be like saved for like an actual emergency. VA loans may be used to finance owner-occupied purchases of 1 to 4 unit residence. So you can actually do multiple units. It can't be used for investor loans. Veterans must occupy the home within 60 days of purchase. So you don't necessarily have to occupy it day one, but you can't, say, hey, in a year from now, I plan on moving in this house. The VA won't allow that. Spouses can occupy for active duty military. Children do not satisfy occupancy. So that's a very key thing. I've had that question asked a lot. Hey, my child's going to be living there. Is that okay? No, it's not. VA guaranteed loan is made up by an institutional lender, but a portion of the loan is guaranteed by the Department of Veteran Affairs. So it protects the lenders against losses from default. So in essence, what they're doing is they're not guaranteeing the whole loan. If the customer is buying a $200,000 house and they're going to take it to 100% financing, the loan amount is going to be $200,000. Okay, so the VA guarantees up to 20% of that. So they're just guaranteeing the first 20%. So that I always tell people with mortgages, Plan A. I tell this to customers. It's kind of my little spill that I do whenever I'm taking an application. But lenders have Plan A and they have Plan B. Plan A is that the customer, so the borrower, pays the loan on time for 360 months or whatever the term of the loan is, and everybody lives happily ever after. Plan B is if the customer doesn't pay, then they have to foreclose. Okay. Now the lenders don't want to foreclose. They don't want Plan B. They want Plan A. Plan B is just kind of like a little safeguard in case Plan A doesn't work. But that's why lenders like having a down payment, because they know that probably if the person is leaving the house, they're probably not going to take good care of it. It's probably going to be some repairs that are needed. And then there's a strong likelihood when they sell it, they're not going to be able to sell it for top dollar. So they want to make sure they have it just enough to at least sell it and get their money back. Well, if we do 100% financing, that's a little concerning because the chances of us being able to sell it for what they actually paid for it, especially if it was foreclosed on, shortly after the purchase, is probably slim to none. So this is where VA comes in. And FHA is similar, but what they do is they guarantee the thing down to 20% of it. So they say, well, if we're so sure that these veterans, if you kind of follow these guidelines, that the veteran will pay on time because we know our people, we know they're disciplined, we know that we've trained these people to have a certain amount of discipline in their life. They're going to make these mortgage payments, and we're so sure of it that we'll guarantee if they don't make the payments, we'll just pay that 20%, of it, or as much of the 20% as you guys get back. So in other words, if the lender sold and was a little short, they would guarantee that leftover amount up to 20%. So that's kind of an interesting thing. That's how mortgage insurance works, by the way. That's what mortgage insurance is there for. It's to ensure that that customer is not going to foreclose on that property, and that they will continue to make the payments. And if you think about it, that's why with conventional, when you're putting 20% down, they don't make you have mortgage insurance anymore, because they say, okay, well, there's enough equity in here. The man, worst case scenario, let's just say they didn't pay and we had to sell his house. Well, surely we can sell it for at least 80% of what it was worth, even after the fees and stuff that we're going to pay to a realtor. So anyway, and okay. So now we're going to get into the funding fee. Instead of mortgage insurance premium, and this is where I say it's a little misleading, VA borrowers must pay a VA funding fee to defray administrative costs of loan programs. So, John, this is kind of what I was mentioning before. There's the funding fee does make this not quite as good of a loan as conventional. But if you have any kind of service disability, it doesn't have to be 100%. It could be 80%. But if you have that, if you check your certificate of eligibility, it'll tell you if you're funding fee exempt. So if you have a service-related disability, you don't have to pay that funding fee. Well, at that point, now you have no monthly mortgage insurance, no funding fee, and lower interest rates. The VA does have lower interest rates right now than conventional. So it actually makes more sense if you're in that boat to do a conventional loan do a VA loan over conventional. So hope that makes sense.
Yeah, it's good.
So yeah. I mean, it's like I said, it's a fantastic program. And what I find is, listen, veterans, we're talking people who've seen war. You know, most of the time that is taxing on someone's mind. I've got lots of, I'm not previous military myself, but I have lots of really, really close friends who are, and they're struggling. You know, there's a lot of, it's a tough thing to overcome psychologically. So you see a lot of this, a lot of veterans who do have some sort of service-related disability, just because of the sheer fact of the mental taxation that it puts on you. So I would say a high percentage of VA employees do have some sort of disability and are exempt from the funding fee. And this is anecdotal. I don't have any full numbers on that. This is all based on my experience with it. So funding fee is a percentage of the loan amount. It can be paid at closing or financed into the loan. Now, this is a nice thing. It's financed into the loan typically. Now, it can be paid at closing, but most people who are doing VAs don't want to bring a whole bunch of money to the table, so they just finance it in. So, financing it in, let's just say the amount is $5,000. Let's just say on a $200,000 house, it would be like $4,600. So let's just say let's say it's $4,600. Is the funding fee. Well, you finance that in, it doesn't make a whole lot of difference in your payment. It does increase your balance by $4,600, either way you slice it. But remember, when it goes into the loan amount, it actually gets amortized over 30 years. So, $4,600 amortized over 30 years is not it's not a real large payment. So you're talking maybe $20 that it's going to increase the mortgage payment. So even if you have to pay the funding fee, it's not a huge burden on the borrower. But in comparison to conventional, in my opinion, if you do have to pay the funding fee and you can do a conventional with 20% down, conventional still makes more sense. Oops. Yeah. Okay. Regular military veteran. So for just a regular vet, it's funding fee is 2.15% of the loan amount. I'm going to show you real quick. I think I can get in here. Give me 1 second. Oh, accidentally. It's okay. Oops. Back up. Okay. So 2.15% of the loan amount for the first use, and 3.3% for every subsequent use. So when we talk about how you can have more than one VA loan, once you use it one time, every time after that, it's 3.3%. What did I say at the beginning? I said 2.3. See, what I did is I mixed those two numbers up. So I took the first number on the second one and the second number from the first number from the first one and the second number from the second one. But no, it is 2.15%. And for subsequent uses, it's 3.3%. Now that's for anything other than reserves or National Guard. So for Reserve or National Guard, the funding fee is 2.4%, and then still 3.3% for any subsequent use. The funding fee does decrease if the down payments of 5% and 10%. So kind of keep that in mind. There's a complete table on the VA website, And I'm going to see if I can get you guys there in a later class. When we go for a break, I'll try to set that up. Hold on 1 second. Going to get my water real quick so I don't go hoarse. Okay. I'm back. All right. So people who are exempt from the funding fee, and we already talked about this, but veterans entitled to receive VA compensation for service-related disabilities. In addition to that, you have surviving spouses of a veteran who died in the service or from service-related disabilities. So that's a good thing to remember too. So just because the spouse wasn't in it, if her husband passed away because of some kind of service-related disability, then we can use that. We can still use VA and not have to pay a funding fee. And like I said, the way we determine whether a funding fee is needed or not is through the CE, the Certificate of Eligibility, or COE really. And I'll talk about that in a little bit here. Eligibility for VA loans is based on the length of activity to duty service in U.S. Armed Forces, of active duty service, in U.S. Armed Forces. So in order to be eligible, the minimum requirement ranges from 90 to 24 months, 90 days to 24 months. And it depends on what kind of service, if it was during wartime or if it was during non-wartime. So the veteran should check with the VA to determine their eligibility. No minimum active duty service requirement for veterans discharged for service-connected disability. So if you join the military and, day one, you took some shrapnel to your leg, or, you had some kind of an accident, whatever it was, and you are discharged because of a service-connected disability, you're still available for a VA loan. It doesn't matter how many days you're in there. So dishonorable discharge will prevent eligibility, although veterans who discharge was neither honorable nor dishonorable are eligible. So dishonorable is the key there. It's just because you were discharged, just because you were discharged either honorable nor dishonorable does not keep you from being eligible. All right. Eligibility for VA loans for reserves and National Guard. So there's a little bit more requirement here for reserves and National Guard. Someone who's served in reserves or National Guard for at least 6 years is eligible for a VA loan, even without meeting the minimum active duty service requirement. So even if they were never active, if they just were kind of serving for six years, and they're still eligible. So VA determines the eligibility, and this is where we talk about the certificate of eligibility. Which veteran use? So this is what they're going to use to determine and apply for a VA loan. Veterans must submit most recent discharge/separation papers. The lender can usually obtain a certificate online. So we have a website that we go to that we just punch in a little bit of information, and it's the VA website. And then it'll pull the certificate of eligibility up. But sometimes it doesn't pull. And I haven't really figured out why it does, and sometimes it doesn't. But when it doesn't pull, what we have to do is get the DD-214, and then we send that into them. And generally within 2 weeks, sometimes sooner, sometimes a little bit longer, we'll get the COE. So getting it online is best option because then it comes instantly. But sometimes it takes a little bit longer. Obtaining a COE. VA Form 26-1880, proof of service documentation. That's where this DD-214 comes in, or an active duty statement of service if they're not retired from military, or a reserve National Guard. Their point of statement is what we would get there. If the veteran had previous VA home that was sold, a copy of the HUD-1 settlement statement. So when you have a VA loan, but then you sell it and pay it off, you get full eligibility back. So they actually restart your eligibility. Now, you still have to pay the higher funding fee for subsequent uses unless you're funding fee exempt. But your eligibility is there. So you have full eligibility, and we'll go over that in just a little bit. So the automated system that the VA uses is called ACE, and that's where they obtain the certificate of eligibilities. It's access through the VIP, which is just this website right here. You do have to have a username and login to get in there, so it's not something that anybody can go in and grab. This is kind of where the website, what it looks like. Go in there. This has actually changed a little bit, but it's more just FYI so you can see. And that's what the COE looks like. So if you notice, I don't know if you can see my cursor or not, but up at the top here, name of the veteran. So this has all their information here. It says what branch of service they were in. And then it goes over here, the bottom area in this little, the little blurb that says under the eligibility, the basic entitlement of $36,000, just under that. That's what it'll tell you if the veteran is funding fee exempt or not. So it'll have a little note in there saying that, yep, they're funding fee exempt. And then that's how we know as a lender. It's just more about if it didn't pull directly from there, how we have to upload one of these documents. So for use of the ACE, it's for use of by lenders and mortgage brokers. That's why I said you have to have a username and password in there, and you have to go get with the VA to get that all set up. No applications for certificate of eligibility needed. So you don't really apply for it. You just got to make sure that they can find it. And that's why sometimes we need extra documentation because the system isn't pulling it up immediately. That social security number and name is all that's required to use the ACE system. I think their year of birth is also needed, but I could be wrong on that. Typically, successful ACE candidates is a first-time user of VA. So it says first-time user. So subsequent users is what is when you'll have a little bit of a difficulty getting it. And if they're discharged after 1980 and served on active duty for 2 years. ACE certificates of eligibility no longer printed on green or gold safety paper. It's now just printed on just regular computer or white paper. And, the DD-214 used to be also kind of the same thing on that green paper. I think everybody remembers that. The authorization number distinguishes the authenticity. So reserves and National Guards, the prior VA loan foreclosures, insufficient time/discharge type, and unmarried surviving spouse. So these are the things that the ACE can't make the decision for. So, it doesn't have the ability to completely grade out the file. All it does is just says, hey, yes, there's some eligibility here. And, this is what they are for as far as if any disability, it'll tell us that too. Eligibility of spouse. Okay, surviving spouse may be eligible. This is a really, really neat point of VA. So surviving spouse may be eligible if the veteran was killed in action or died of a service-related injury, and the spouse is not remarried. So it may also be eligible if the veteran's missing in action or is a prisoner of war. So there's certain situations. Hopefully that's not something that's happening. I know it does happen, but if God forbid that is the situation your customer's in, that is something that they can get eligibility for a VA loan. So some of the essential features, significantly reduces lenders' risk of loss in the event of a borrower defaults. This is where I said they come in there and they guarantee that first 20%. The amount of coverage for a loan is called the guaranteed amount. Guaranteed amount for a loan depends on the loan amount and maximum guarantee amount in county where the home is located. When VA loan program began in World War II, guarantee amount was $4,000. Over the years, it was increased periodically to reflect increasing housing costs. Eventually, instead of having a single guarantee amount for all loans, guaranteed vary with the loan amount up to a specified maximum. And like I said, that probably maybe sounds foreign, but I'll go over in detail kind of how you do the guarantee amount. So now the VA's maximum guarantee is it's tied to the conforming loan limits for conventional loans. It increases every time the conventional loan limit max goes up. So does the VA's limit goes up with it. So it just follows right along with conventional loan limits. And it can change each year. Sometimes it can change multiple times in the year. I've seen that happen. It's increased quite a bit. For the longest time, it was 500, I think. Maybe it's 417 even. But now it's 510, 200, I believe. I think it's 400. It's either 510-200 or 510-400 is the max conventional loan amount. The amount may change each year. Check with the VA for most current figures. Real quick, I don't know why I'm having a brain fart here, but I want to see what conventional loan limits are. 510-400. I was on it. Leave me alone. Okay. So the maximum VA guarantee in most areas is 25% of the Freddie Mac conforming loan limit for one-unit residences. So again, I'm going to get into the math of that in just a little bit, and we'll go over some scenarios so you guys can kind of see how what that actually means. Currently, Freddie Mac's conforming. Oh, I need to change that. Man, every time I do this class, they change it again. Let me back up. See if I can back out of it. So I'm gonna read it. So I'm not gonna mess with it right now, but it's actually, so conventional just has changed. It's now 510-400. So but it's still for number's sake here, we're gonna use the 25%. So in 2015 we were looking at 453-100. So if you took 25% of that, you would get 113-275. Okay, that would be the guarantee amount. So then you multiply. You take the way they got that number is they just took 25%. They multiplied it by times 0.25, and that's the amount of guarantee. And the reason they do it like that, it seems kind of silly, because it's like, well, why back into it just to then use a multiplier of 4 on it again to get back up to the max loan amount. I'll show you in just a second. So the higher maximum guarantee amount applies to the high-cost counties. High-cost counties where the median house price is higher than the national median. Georgia only has one high-cost county, and that's Greene County, Georgia. So if any guys are doing stuff there, it's actually the max loan amount's a little bit higher there. Maximum VA guarantee in most areas is 25% of the Freddie Mac conforming. I thought we just did that. We did. I went backwards. Okay. In high-cost county, maximum guarantee is based on the median housing price in that county. The higher the median housing price, the higher the county's maximum guarantee. But no matter how high the prices are in the county, the maximum guarantee can exceed the ceiling. And like I said, we're going to get into the more situations here, so just be patient on that. There are special even higher maximum guarantee amounts in Alaska, Hawaii, Guam, and the Virginia Islands. I don't think a lot of you guys are probably doing a whole lot of business there. I have a lot of traveling to be showing somebody a house. So I'm thinking probably not. Not all VA borrowers in a particular county get the county's maximum guarantee amount for their loan. A guaranteed amount is available in particular transactions depending on the loan amount. Okay, so here we're going to get some of the math of it. The guarantee does change based on the loan amount. So if you're doing a loan amount of $45,000, it's much different. Now, most of us, where I'm going to focus on mainly, is the 144 to 453, because most of us are seeing with VA loans houses in this price range.
It was quick.
Somebody have a question?
This is John. There was somebody earlier said, will there be a way to get like a PDF of the presentation? Or
yes,
something like
absolutely.
That? Okay, cool.
Absolutely. Let me see. I'm trying to find. I don't know why I'm. I think I have to unshare my screen, and then give me 1 second. I want to make sure. Okay, and then I think I can see the notes, the chat thing. I need to remember to check those from time to time. Chat. Okay, so I'm gonna stop and look at any of these questions. If you guys have any questions, feel free to put them in here. Can you refinance into a VA loan? You can refinance into a VA loan. That's a very good question. And I'm going to, you can kind of see, I'm in a room downstairs. I'm refinishing a room in my basement. So I told you I have 5 kids, so I got to really like hide, or else you guys would be here screaming and yelling and all the rest of that stuff. My oldest is 12, my youngest is 6 months, and I've got them all in between there. So anyway, if you see like some construction, I tried to find a place where you wouldn't have to be seeing like, sawhorses and all the rest of that. Okay. So can you refinance into a VA loan? Yes, you can. Not bad credit, but no credit. That's a good question. You don't, and we're going to get into the credit stuff in just a little bit, but I will go ahead and answer. You don't have to have any credit. We can use what's called non-traditional credit. I shouldn't say any because we still have to use something. But that something can be non-traditional credit. Are there any handouts? There will be some handouts. I'm going to send you guys this sheet here, the PDF thing. I'm going to have my brother Dustin send that out to everybody. And I'll see if we can get it posted on the website too. I can hear you. TVs and phones. Yeah, we got that. I think these are all earlier stuff. I'm just looking real quick through the questions. And that was it. Wes, how does VA benefits count? So, good question. VA benefits count. You can use 100% of the income. You can actually use more than 100% of the income. So VA allows you to gross up by 25%. VA benefits are just by nature not, I should say like disability benefits. So disability is non-taxable. So if you have disability benefits, then at that point you can gross it up. And the idea behind grossing up, just so y'all know, is what that means is you can actually use more income to qualify to lower the debt to income ratios than what you actually get. The reason for that is we know that there are DTI, debt to income ratios, that lenders look at. But for DTI purposes, they allow the gross amount of income to be used. Well, that's not really how much income that people get. You know, the gross amount is not what you actually deposit into your bank that you get to budget off of. It's the net. So what they say is, well, since we let most people that have taxable income, we let them still use that full amount. We'll let people who their income is truly what they get, we'll actually let them use a little bit more than that to kind of compensate for the fact that that the gross amount is their net amount. So they actually allow you to increase that by 25%. So just multiply that income times 1.25, and that'll give you the actual income that you can use. Kind of a neat little thing there. For regular benefits like pensions and that kind of thing, you would just use, if the pension is non-taxable, you can still gross it up, but you would just use that amount. The key is that it has to be continuing for at least 3 years. I'm pretty sure that all pensions for VA are lifetime. So it's pretty easy on VA loans with that. Okay, so I think I answered that question. I think I did answer about the handouts. Yes, there will be. That went all the way back to the top. Oh boy. What if the income is there? What if their only income is disability? Doesn't matter. So you can still, if only all your income is disability, you can still use it. Now, the key is you still have to qualify from with your residual income. So sometimes just disability income is not a lot of money, and but just so long as you meet the residual income requirements and the DTI requirements, you should be fine. So and then I just heard somebody, is it Kathleen? You said that you just closed the loan 2 months ago with DTI ratio 52. Yeah. Yeah, like I said, I've seen one with 70. Typically, you're going to see that with somebody who's making more income, because when you have more income, residual income is typically more, and I'll explain that in a little bit. So, all right, let's get back into it. And I'm going to try to break at the top of every hour, guys. We'll take a 10, 15-minute break. Let me see. Where's my? Oops, got to share first. This is my second Zoom meeting ever, so. And I had issues in the very beginning. For some reason, I had to call my I had to call it. It wouldn't let me do it through my computer speaker, which is weird. But where's my share screen? The last time I did this too, for you guys that were on the last class, I did not have my beard, but I've become homeless since then, so that's why I can't shave. That's not true, but I do feel kind of homeless when I have my beard, and my wife hates it. So, but it's cold in the winter, so I think it's fair that I have one. All right, 25% of the loan amount guarantee up to the county max. Guarantee amount available for particular veterans to use is called the Veterans Entitlement. Veterans Entitlement doesn't expire. Availability until it's available until it's used by the veteran or unremarried surviving spouse. So if you are, just a keynote, if you're a surviving spouse and you get remarried, you lose your, unless you're married to another veteran, but you lose your entitlement. I actually was working with someone else the other day. They said her spouse had passed away years ago, so she had the VA benefits, and she's been with another guy for a long time, but just is not getting married because they don't want to lose the benefits of it. So entitlement is used and no longer available when the veteran obtains a VA loan and buys a house. So remember, it's not all the entitlement, it's just whatever portion of the entitlement you use to buy the house. Restoration of entitlement when home is sold. So if you sell the home, and I mentioned this earlier, veteran sells the home and repays the VA loan, the veteran's entitlement is restored. It restores the full amount. So the veteran can use it to obtain another VA loan. So restoration of entitlement when the loan is refinanced. So the entitlement is also restored if an existing VA loan is paid off through refinancing. Obviously, you'd still be using more entitlement if you refinance it through a new VA loan, but if you're doing it with a conventional loan or an FHA loan, you would not have to use your entitlement. I can't imagine why you'd go from a VA to an FHA, but and we'll talk about IRRLs, IRRLs, interest rate reduction refinance loan. That's what that stands for. It's a lot of R's. But they are super easy. I mean, you literally just have to have a heartbeat. It's just a credit application, and that's it. I mean, there's really nothing. They'll refinance the VA loan with no information. It's really nice. Now you can't go out getting cash out of it with it or anything like that, but you can certainly lower your interest rate. They are really, really easy to do. If anybody knows any veterans or any of you are in a VA loan and your rate is above 4%, call me because we need to refinance you. It's super simple. Restoration by paying off the loan without selling a home. So if you just pay the loan off, and that's the whole thing about selling a loan or selling a home, I should say, or refinancing it. All you're doing is just paying off the loan. So really, this kind of goes without being said, because if you understand why it gets restored when the loan is paid. So also, the veteran who pays off the VA loan but doesn't sell the home can still be, it can be used to restore the entitlement to purchase another home. So you're only allowed to do this once. I don't know why that is, but they only allow you to do it once. And you must occupy the new home because the VA is owner-occupied requirements. VA does not allow you to do investment properties. So VA guarantee doesn't necessarily relieve borrowers of personal liability for the loan. So just because the VA guarantees 20% doesn't mean the lender won't still come after you as a veteran if you default on the loan and there's an outstanding balance. The lenders absolutely have the right to do that. Under limited circumstances, veteran may be liable after default or for older loans after the loan is assumed. So there are times that just because you went default the loan, you could still possibly get restoration on that. So liability to VA. If the veteran defaults and foreclosure sale results in a loss, VA must reimburse the lender. As a general rule, the veteran is not required to pay the VA for the amount paid to the lender. Loan closed on or after January 1st, 1990, the veteran is required to repay VA only if guilty of fraud or doing some kind of fraudulent. All these things are fraudulent activities. When veterans are required to repay the VA, an amount owed is delinquent federal debt. So veterans, federal income tax refunds can be applied to it. Any federal pay can be garnished. The veteran isn't eligible for any federal loan. So on federal loans, which examples of federal loans would be the VA and FHA. So for federal loans, they pull what's called a CAVERS. And the CAVERS just goes back and checks and see if there's any outstanding federal debt against the customer. Sometimes this debt won't show up on a credit report, surprising enough. I did a loan for a friend of mine. He's actually my assistant coach. He's also a realtor. And back when we first met, he was using another lender. And he had said, man, they just can't get me approved. I don't know what's going on. And so I looked at him, we did some credit work, got his credit score up. It was actually pretty easy. And I went through my whole spill on every application. That's one of the questions that your loan officer should be asking is, are there any outstanding, do you have any current delinquents on any federal debts? And that could be like student loans or FHA loan, VA loan. And then he said no. And then halfway through the process, Capers got pulled because the processor pulls these. And there was an outstanding student loan on there that he had, there was a collection on. And so I asked him about it, and he goes, well, I didn't think that would still show up. And I'm just like, oh my goodness, like help me, help you type deal, you know? Because if I had known about that earlier, I can do a lot with it. It makes it real tough 2 weeks prior to closing. So we kind of did some fancy footwork and ultimately got him approved. Man, it made it real tough. So it made it tough on him because ultimately the onus was on him to kind of go out there and get he basically took out another loan to pay off that loan, to pay off that collection. I think it was, I can't remember what the debt was. I think maybe it was a student loan. But anyway, you don't want to have that sitting on you because that keeps you from getting any kind of financing for federal loans. So even if the veteran is not required to repay VA because the case didn't involve fraud or bad faith, loan guarantee entitlement won't be restored unless the veteran makes arrangements to repay. So if you were to foreclose on something, the veteran needs to make some kind of arrangement so that they're paying the VA back, or you won't be able to use that VA again. Now, I know what you're thinking is, hey, didn't you say that you could have a foreclosure and still use a VA? Yes, but a foreclosure on a conventional loan or an FHA loan is typically what we see. If you've had it with the VA, you need to have paid that loan guarantee portion back. So if part of the lender's foreclosure doesn't, part of the lender's foreclosure loss isn't covered by the guarantee amount, the debtor may be liable to the lender for the uncovered amount. So, if there's still $10,000 that the lender got shorted, they can absolutely go after the customer for that. State law restricts deficiency judgments would apply. So I should say state law restricting deficiency judgments would apply. So they can stick a judgment on you that'll prevent you. It'll hurt your credit and it'll prevent you from getting a loan. VA loans can be assumed by other creditworthy buyers. So we talked about this earlier. It can be a veteran or non-veteran. If loan closed on or after March 1st, 1988, parties must obtain approval from the VA or the lender. So either one is fine. It doesn't have to be in both. And then otherwise, the original borrower remains liable. So if you don't get permission, then they can assume it, but that's not really even assuming it, because if that person defaults on it, the original owner of the loan is the one who's liable. Assumption will be approved and original borrower released if these conditions are met. The buyer meets the VA underwriting standards, the loan is current, and then the buyer assumes all the original borrower's loan obligations. So if you're in default on your loan right now, they're not going to allow you to assume it, which is kind of dumb, really. I mean, if you have a more creditworthy person that's trying to assume the loan, and you got a guy who's struggling to make the payments, it seems like they'd allow you to do that. Okay, I'm going to test real quick here. I want to see if there's any questions. I'm sharing. Okay, is the VA loan restored if your loan is assumed? Yes, it is. So no, and I think it's actually going to get into that. Give me 1 second. I think it's getting ready to get into that on here. Where's my share screen? Share again. Okay, so here we go. I knew it wasn't like a cut and dry thing. So it's not automatically restored after assumption. Restored only the assumptor, so that the buyer is an eligible veteran, has entitlement equal to, so they have to have an entitlement there, and agrees to substitute their own entitlement, and then they have to request a substitution for VA. So downside is if you let a non-VA customer assume a VA loan, then the original borrower is the one who loses the entitlement. So good question. And like I said, it's not a yes or no, it's a maybe. So If it's to another VA person, there is a possibility, but there's a few different stipulations that have to apply. The VA loan can be used to refinance any type of loan, and this is where we talked about before. Somebody said, "Hey, can you refinance into a VA loan?" And the answer is yes. You can refinance a VA to a VA, which would be typically an IRRRL, which is so easy to do. Conventional, FHA, or seller financing. So even if you did like a private loan, VA still would allow you to refinance it, and from that. Can be used to pay off other liens too, such as tax liens and judgments. This is a really cool thing that VA allows you to do. VA allows you to add in things that most programs wouldn't. Most programs would call cash out, but VA will allow you to pay off those by refinancing. If refinancing a non-VA loan, the guarantee entitlement must be used, of course, because you have a new VA loan. The refinancing amount can exceed old loan balances, so that the veteran also can gets cash from the loan proceeds. But refinancing can exceed 100%. So let me kind of go back from this. So it says can get cash from the loan proceeds, but it's not like you're getting a bunch of cash out. So the refinancing can exceed 100% of the appraised value plus funding fee plus cost of energy. So you can still do 100%, but you can't go above that appraised value. Plus they do allow you to do the funding fee also. And if you were doing an energy efficient improvement, you could actually add those into, which is kind of neat. I actually did an energy efficient refinance, but with an FHA loan. Normal VA underwriting standards apply. Different rules apply for streamlined refinancing. Refinance existing VA loans just to take advantage of lower interest rates or replace ARMs with fixed rate loans. So this is where we talk about refinancing and doing a streamlined refinance. Loan amount limits to old loan balance, closing costs up to 2 discount points. So like I said, when you're doing a VA to VA, you're doing an IRRRL, you can't pull cash out. You can only add in these things: the loan balance, closing costs, and up to 2 discount points, 0.5% funding fee, and the cost of the energy efficient improvement. So a lot of times people see this and say, okay, so it's 2%. That's what we can't go above. Well, that's not what it's saying. 2 discount points. That's in addition to all the closing costs. Now, you have to remember that they don't allow you to go more than 2 discount points over what the closing costs are. Underwriting is not required. And that's why I say on these IRRRLs, they're really just easy. I mean, it's about as easy of a loan as you'll ever do. So just going over the summary real quick: guaranteed amount, maximum guarantee amount, entitlement, restoration of entitlement, remaining entitlement, substitution of entitlement, refinancing, streamline refinance. That's all the things that we just hit. I'm going to take a break, 10, maybe 15 minutes here. I know it's tough when you're just kind of sitting in front of a screen. It's a little different. It's definitely more difficult to do these online than it is in person. But this is kind of what we've got, and I appreciate you guys all sticking in there. So, like I said, we're going to take a little bit of a break here, and then we'll come back in just a few.
Wes, you're doing a good job.
I appreciate you, brother.
It's hard, man. When you can't.
Yeah, like I said, I'm an in-person guy. Like somebody told me one time, like you don't get you talking to you on the phone. Now the screen does help for sure. You know, you can kind of see people's facial expressions and that kind of thing. But I'm definitely an in-person guy. But you know, you got to be able to adjust sometimes.
So do we have 15 minutes? 15 minutes?
Yeah, I'd say 15 minutes. We'll come back.
All right. Thank you.
Yeah, you're no problem.
Wes, one of the things I learned being a veteran, also being in the business, is that the veterans that are active duty, they are made aware many times by their HR people and also by competent loan officers that if they what do you call it, foreclose or get behind or whatever on their loan, it can affect their promotion. So they are very, very diligent for the most part, if they're making it a career, to stay up with that stuff. Yeah,
you're absolutely right. And what's funny is that when the housing crisis happened, everybody started really like cracking down on their guidelines. They started really tightening up on what their requirements were. VA never stopped performing. VA loans always performed well, but the I think it was the government came after them, one of the agencies came after them saying, hey, you guys need to stricten up your guidelines. And they were kind of like, they just basically told them like, hey, stay in your lane. We're doing fine. We're still performing. Our guidelines have always been good. You guys are the ones that are struggling. Don't put your problems on us, in essence. So, yeah, it's pretty funny. Just VA is a superior program. The way they approve the loans too is pretty good. But I think to your point, when you know that your promotion and all of a sudden it's more. There's more things. It's a culmination of things. I think it's the discipline. You got people who you're saying, hey, you know what? We're these are people who we've drilled in discipline into their mind. By the way, also, this can affect any kind of future increase in income, or your status as a VA member, whatever. Yeah, that's going to give people some motivation there, So
I got two questions for you. One is,
Mhm.
we're in the Hillgrove district, so we're sitting on we've been paying ahead, and we're sitting on a lot of equity, and we're looking. It's been frustrating. We're looking for acreage. Once we secure the acreage, could a VA be used on new construction or no?
Yeah, absolutely. They could use it as a final loan to pay off. So it depends on what we're talking about. If you're going to build your own house,
right,
you would still have to get you'd have to get a land loan, and then I'm assuming, unless you had cash to pay for the land.
Yeah, we'll have enough for the land. Yeah, we'll have enough for the land.
Okay. So then you would typically get some sort of credit line. It's called a construction loan, where, for all the materials and paying all the people to build the home. And then at the end of those, you typically would do a refinance into where you combine, any of the land loan and then refinance that construction loan, because the construction loans are typically shorter terms. That final loan can be a VA loan.
Okay, cool. And then when they do the underwriting, excuse my ignorance, sometimes I know a lot, but then sometimes I don't. When they do the underwriting, obviously I'm a veteran, but my wife is not. Do they use both of our incomes to do the underwriting just like any other loan, or on a VA? Or do they just use mine?
So I'm sorry, say that one more time.
When they do the underwriting on a VA loan, do they just use my income, or do they use our, husband and wife's income?
No, that's a good question. So only one of the people on the loan application has to be a veteran. So,
okay, but
it needs to be the primary borrower. And yeah, so anybody on the loan application, we can use their income. So we can use both income to answer your question.
Outstanding.
Yep, it's pretty fantastic. And I gotta remember to go charge my phone here in just a second. Last time I was teaching this class, my headset started going out on me, and that was fun.
Oh, you're loud and clear. You're loud and clear.
Yeah, well, my earbuds just ran out of batteries, is what happened. So I was like, oh no, and I couldn't figure out how to get, but at least now, since I did call in, I can put it on speaker. Worst case scenario. Well, the nice thing about these earbuds is they charge so stinking fast. Price. Updating some of these scenarios here. I didn't want to get too much into the.
Yeah, it's tough. You're going through the presentation, and everyone's got good questions, but they don't know that if they just kind of stay with the flow, that their question probably will be answered.
Yeah, I saw that. Like every one of them, we ended up answering through there. It's been a while since I've done this VA one. Because we typically kind of cycle through. We've got about 5 courses that we teach, so I'm seeing some updates in here that I'm trying to fix.
Since we're on break, I'll do a little more plug. I'm also the new commander of the DAV 2,000 plus member Marietta chapter. So sometime early next year, I'll have you and or Jay come out, and you guys really give them a show.
Yeah, I would love that. I would absolutely love that. Let's connect after this, if you don't mind. Where do you live about?
I'm in Powder Springs, but I'm part of the West Cobb branch, which is now being consolidated into the new mega branch that they're building out there by.
Oh, really? Yeah.
Paulding County.
That's awesome.
Yeah. So.
And you're actually you're a Max 1.
Yeah, Max 1. Yep.
Gotcha. I think this class you don't have to be max 1 to take this class though, right? Because I know at least in the in-person classes you weren't required to be max 1. You could be.
No, anybody can take the max 1 free CE classes, and that's really a wonderful. We don't recruit. We just matter of fact, it was funny. 9 years ago, I took a couple of CE classes, and in Woodstock, and Dave Kubak goes, "Do you mind if I have a few minutes with you when we're done?" I go, "Oh, sure." Or he goes, "No, check out the website." No, check out the website. That's what he said. And back then, we only had 5 compensation plans. I think we have 7 now. And I checked, and then the next day he goes, "You mind?" I go, "Look, you can take. I can give you 15 minutes, but I went through everything you asked me to go through, and I go, I'm pretty much ready to sign up." So 9 years later, when he sees me, he goes, I forget what he says. I always tell him this: "Dave, if I leave you, I'm leaving the industry." Okay.
Yeah, that's so funny.
Because the reality is there are good operations everywhere. I mean, you just have to be an entrepreneur and just go out there and build your business, I mean, it's.
Yep, you're absolutely right.
We might not have the recognition nationwide of a Remax or a Keller Williams, etc. But in Georgia, people know Maximum One. So
yeah, you're absolutely right. Oops. Trying to do this example. We're getting ready to go through an example here of doing a jumbo loan, but I'm trying to update. Should update these slides to reflecting the new loan limits. Yeah, John, I actually live in Kennesaw, so I'm right next to KSU, so I'm not too far away from you at all.
yeah, I go all over the place, so it's not a problem to meet anywhere. In fact, a good thing, like on the 11th of every month, it goes back to 9/11. Reveille, which is a fine eatery, breakfast and lunch, and they have several locations now. They do 50% off for the veteran, so it's pretty good.
That's awesome. That is pretty good.
And of course, this weekend coming up, there's a lot of discounts everywhere because of Veterans Day. So.
Yeah. I know. I saw it with I bought like $200 worth of clothes for one of my daughters. I'm starting to realize I need to have a second job just for clothing for my kids. But I went to Old Navy and went in there and dropped a bunch of money. And then as soon as I'm like, they handed me this little thing like, "Hey, this weekend everything's 50% off." I was like, "Are you kidding me? Why didn't I wait?" And it was I think it's a Veterans Day sale. So
I know it's not like the old days when I was growing up. Well, we had kids almost in every household in our area where I grew up in the suburbs of Detroit, and I pretty much got hand-me-downs all the way till I was like 14. I got my first pair of Levi's when I was 14 years old.
I know, right?
Thought I died and went to heaven because the guy next door to me,
I know.
he was the same, relatively the same size. So he'd always say, "You want these?" I'm like, "Sure." Well, I mean, you can't do that nowadays. The pressure is just so intense on these children, but peer pressure.
Yeah, we still, my wife and I, we're pretty good at like my wife, like I hate to say she's a hoarder, but because not in a bad way, but she saves the kids' clothes and then she'll get them back out when the next kid turns the next stage. Now, didn't really help my son because we had all girls after him, so we had boy and then 4 girls after that. But still, from a just from a being efficient with the clothes that we had, it's pretty impressive. Now I'm the sucker that always one of my little girls is looks me in the eyes and gives me those little sad eyes and can I get some clothes? And I'm like, okay, fine. So it's hard. Yeah, do you got any children?
One grown, 25, and I got 2 stepchildren, 18 and 21, with my second final bride, and You notice how I said that? Yeah.
Yeah, I know, right?
It's I don't have any ministry in my church yet, but one of them is when I hear people talking about thinking about the D word, I say no, 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 no. It
Yeah.
will not only will it crush you financially, but it takes a long time for children's wounds to heal. And you just I tell people at all costs, exhaust all possibilities, because I
Yeah.
went down that road. In fact, I tell people now, if I was as spiritually mature back then as I am now, I'd still be married, because anything can be fixed. It really, truly can be. Except,
Well, I think that,
abuse is, I mean, that's a tough one. I shouldn't say everything, but yeah, you can
I
fix
think
small things.
I think that shows a lot of maturity, because I definitely think, and I'm not trying to put, look, I saw my mom go through some really tough stuff with my dad. My dad's just not an easy person to get along with. So I know there are always extenuating circumstances, but I do think
Vietnam vet? Was he a Vietnam vet?
No, he had some military time.
Okay.
And I don't think he was in Vietnam. Maybe he was. I don't know. I feel like I should know that. I talk to my dad all the time. We don't really talk a whole lot about his military stuff. I just think I know his time in the military messed him up pretty good.
Mm-hmm.
But I don't know if it was Vietnam though. But anyway, I think it was just military in general. I think my dad ran his mouth a lot and probably got, I think people, when you're in a group of guys, you just can't do that kind of stuff without getting beat up a little bit.
Right. Right.
And he's a jokester. He loves, pulling pranks on people. And I don't know. I could see how that would, people kind of get a little upset with that.
Yeah.
Okay. Now I can remember where we were at here. Got 2 more minutes. We'll start back up. I think there's a way. I think there's like a board thing on here that I can do where everybody can see. I'm trying to find out where. Actually, I think it's under the share screen option.
Yeah, I'm see part of it, and we got it up top.
Cool. Can you see that?
Yeah, I can see that. You got me.
I don't like that. I got it. Okay, so I don't want to do that. I want to go Z. Okay, but I want to text. So I could do stuff in there. Okay, sweet. I'll do that then. That's great. I like that a lot. Now let me figure out how to get out of here. Clear. Like I said, I figured out something new. I'm fairly tech savvy, so I don't like struggle with this stuff generally. But I think so. Just going to stop sharing. Yeah, that's cool. Okay, let's go ahead and start again. I'm gonna get my phone charger, then we'll start again. Hold on, I don't want to run out. That would be worst case scenario. Yeah. What? Nothing that suggests you get those curious stuff. That's good. Huh? Maybe email. You can use a translator too. You know what I mean? Okay. Okay, let's get back into it. So I want to go, first I want to plug my phone in, and then I want to go into, I'm going to go back into my screen here. And I want to go back to, let's go a little more. Up there. It's up here. Okay, so I want to go back into this screen. Let me check real quick again and see if there's any more questions. I think I saw another question. Okay, great job. Well, thanks, guys. Thanks for the encouraging things. That's great. Shelly, you keep asking, or somebody keeps asking where we get some handouts. I don't know where there's handouts per se, but I know that we're going to send the slides to everybody. You can kind of poke around here. I don't know if Dana has posted any handouts, but okay. If you, I know typically in class I would have handouts, but I'm sure you could email whoever from Max One and try to get that. Okay, so if you use your VA loan once and had a funding fee, but now about to purchase again, and now 100%, is a 3.35 still in play? That answer is yes. That's a good question. Yes, so that would be considered a subsequent use, and you would have to pay the 3.3%, unless of course you were funding fee exempt. I'm not sure if I included my email earlier. Okay, great. It's great. It's great. Okay, so let's go back to screen sharing again. And let's go to new project. Okay, so I updated these loan amounts here. So you'll see it's 510, 510, 400. And so you can, your entitlement is 25% of the loan amount. So that comes into play here in just a little bit. They're going to go over some scenarios, and I'm going to get on the whiteboard for a little bit. And I want to kind of show you guys how the entitlement is calculated, and how you can use do multiple VA loans. Okay. And then I suspect I'm going to see some questions there. So that's an interesting point that you definitely do not want to miss. Okay. So VA doesn't set the max loan amount. VA's only rule is the loan amount can't exceed the appraised value of the property. VA approved appraisers, they're the ones that do the appraisals. And then they'll issue what's called an NOV, or a notice to value. They issue it to the lender, so it's nothing that you guys will ever see. But of course, if you want to know, I should say, if you want to know and you're not the listing agent, I made that mistake one time where a listing agent had asked me, and me being, generally wanting to help. She said, yeah, hey, what did the house appraise at? I'm just curious. And I was like, oh, 210. Well, the sales price was only 200. And when the listing agent found that out, the buyer tried to negotiate for something else, like some fixes that needed to be done. And the listing agent responded back by saying, no way, we're not doing these repairs. You're getting a $210,000 house for $200,000. And I felt like the biggest horse's butt. So ultimately what I did is I learned from that. And that was probably about 2 years ago. And yeah, I've had agents try to ask me, listen, agents, hey, what the value, what the appraise come back at? And I said, look, the appraisal's the borrowers, you got to ask them. That's kind of how I handle that from here on out. So, okay. So VA only rule is that the loan may not exceed the appraisal value. If the sales price exceeds the appraisal value, the borrower must make up the difference with his own funds. So if you, and this is the way it is with every loan, but if you buy a house and you agree on a $200,000 purchase price, but it only appraises for $195,000, you, the customer, have to come up with the additional $5,000. So that's just kind of how that works. Only other restrictions on loans, the loan amount comes from the lender, not the VA. Lenders generally want the guaranteed amount to equal at least 25% of the loan amount. Homestar is no different, by the way. Otherwise, it's hard to sell the loan on the secondary market. So they want the loan amount to guarantee for at least 25%. I think I said 20% earlier. It's actually 25% of the loan amount. So most lenders won't make a no down payment VA loan for more than 4 times the guarantee amount. So for larger loans, down payment required. Guarantee plus down payment must equal at least 25% of the price. And I know that's probably seeming kind of confusing to you guys. If you're anything like me, it confused me, and it took me a few times of people explaining it to me years ago. And I actually went and watched a YouTube video that explained it real, real well, and then understood it. I was like, okay, this makes a lot of sense now. So here's an example right here, okay? So this would be an example of a jumbo loan because we're over that 510 400 conforming max limit. Okay, the maximum VA guarantee. So it's 25% is what your guaranteed amount. 25% of the conventional loan limits, which is 510 400. So just doing that math real quick. Let me get my trusty calculator / phone. So this is how that math looks. You take 510, and you can do this with your own computer. So $510,400 times 0.25. That means your max guarantee is $127,600. You'll see that reflected up top here. So the lender won't make a loan for more than $510,400. So that's the max that the lender will make a loan for. Okay. So the way that it works is they look at they look at the sales price, which it would be 0.25%, and then they look at the guaranteed amount, which is $127,600. So the max that 25% of the guarantee amount is $130,000, but we only have $127,600 guaranteed. So that leaves us with $2,400 left over. So that would be the down payment requirement on this loan scenario. Sales price of $520,000, down payment is $2,400. Still, you're talking about a jumbo loan with a $2,400 down payment. So let's just do the math on that real quick. 0.24 times, let me see, I'm sorry, 2,400 divided by 520. So we're talking about a 0.4% down payment. That's pretty strong, especially for a jumbo loan. So let's keep rolling here. Full entitlement can't be restored if VA loan is assumed by the non-veteran, which we knew, but the veteran may still remain entitlement that can be used for another VA loan. Determine the remaining entitlement amount available for a new loan. So new loan amount 144 or less, subtract 36,000. For new loan amounts over 144, subtract the entitlement used for the old loan for the maximum guarantee amount of the county. In most areas, and that's 2015. I'm going to fix that real quick. We said 147, I believe. 127.6. Actually, 27,600. Try to get those when I was on break, but I guess I missed this one. So I'm going to give you some examples here. I'm going to get to the whiteboard, and I want you to because I want you to understand this, and then we're going to talk about what how people do multiple VA loans. Let's go. I figured out this whole whiteboard thing on the break, so it's kind of neat. And I'm going to go to text. Or with text, we'll go here. So we know our max guarantee amount is, we'll say 25% of the conventional loan limit, which is 510, 400. Okay. Okay. So knowing that, our max guarantee is, what was that, 126.7? So max is 126.7. Let me make sure that's the right math. Come on. 125 times 510, 400. Okay, so 120. Oh, actually, I transposed it. 127, 600. So that's our max guarantee. Okay, so let's just say we have a purchase price of, I'm going to say 180,000. Okay, I know there's not a whole lot of homes selling for 180,000 right now, but just humor me. The guaranteed amount needs to be 25% of the loan amount. Okay, times 0.25, which is the guarantee amount. Okay, so and the reason what I'm trying to show you is that there will be leftover. That's how much of the entitlement will need to be used. It's 0.25%. So let's do the math on that. 180 times 0.25. Okay, so $45,000 of entitlement was used, or guarantee amount. Okay, so remember up here we have 127.6 available though. Okay, but we only used for this loan scenario, we only used 45,000 of it. So let's just say years down the road, this guy says, hey, we want to buy another house. How much could we get for over 100,000? Or sorry, I should say for 100% financing. So what we would look at, we would say, okay, well, let's just see how much entitlement you have left. You had 127. Entitle. I should say, I keep saying guaranteed. I should replace this. Max, I'm going to say entitlement. I'm sorry. They're sort of synonymous. And maybe I spelled that wrong. That's okay. Okay, so 217, 127, but we use 45,000 of that. Okay. Used. So we take the difference of that, which is, and you guys can be doing this on your own calculators. Say 127,600 minus, they've used 45,000 because it's always 25% of whatever the loan amount is. Okay. So now that leaves us left over with $82,600 left of entitlement. Okay, so that's how much you would have left over after buying a $180,000 house. Now the question is, okay, but what does that mean for a purchase price? How much of a home can we buy? So it's a very good question, and the amount of home that you can buy is 4 times that, because you have to reverse the math. It's 25% to get down to entitlement. If you want to get that to loan amount, you have to multiply it times 4, because 25% is 1/4. So the opposite of which is 4. So you multiply that number times 4, and then you get to 330. So 820, 82,600 times 4 equals 330, 400 left of entitlement. Okay. Or left, I should say, it's not an entitlement. That's how much left of loan amount at 100% financing. So the customer could still get, after they bought this $180,000 house, they could still go up to a $330,000 house and some change at 100% financing. Okay, so questions there. I'm going to back off of this for a second. I want to know any questions. Does this make sense? So your max entitlement amount is 25% of the conventional limits, which means it's $127,600. With a purchase price of $180,000, you're still going to use 25% of whatever the loan amount is. So that means you're only using $45,000 of your entitlement. That's 25% or 0.25 of $180,000. Okay. So then we take 45,000, we subtract that from 127,600, and we get 82,600 left of entitlement. So How does that translate into loan amount? We multiply that times 4 to get back to the loan amount, because if the entitlement is 25% of the loan amount, then we know that the loan amount is 4 times what the entitlement is based on elementary math that probably most of us have forgotten. So don't feel bad if you're struggling with this. I only know it because, like I said, I have 1,000 children and I have to teach this stuff to them because my wife struggles with math very badly. So normally she calls it the big guns whenever she has math stuff that she needs help with. So 330, 400. Okay. So any questions? I'm going to unshare this for a second so I can see. All right. Well, primary residence. How do you buy a second home? You cannot buy a second home using VA. It's just primary residence, and that's it. Any questions about the whiteboard stuff? I'm going to go back to share screen. Feel free to unmute yourself too.
The new acquisition would be your primary residence. The other property would be considered secondary. Is that correct?
Yeah. Okay. So yes. So you can't finance a loan as a primary residence, you can't finance a loan as a second home or an investment property. You can turn a primary residence into an investment or into a second home. So absolutely, it would. I mean, it's kind of, it's what you call it is totally up to you. I mean, because you're not going to be financing it anymore.
Well, this came about, isn't it? Because I mean, a lot of active military, they get a new duty assignment every 3, 4, 6 years, whatever. So I know a lot of veterans, they haven't sold their properties. They just become secondary, and the new acquisition is their primary.
You're absolutely right. You're absolutely right. And that's they do that. And I think a lot of veterans are realizing, hey man, I can really build some wealth doing this, man. I'll go and live in a house for a year and then I'll go and buy another house. You know what I mean? I don't have to have any down payment. And then in the period of time they're doing this, 3 years down the road, they could buy 3 houses. So here's something that's going to really blow your mind right here. I don't know if it'll blow your mind, but it's kind of neat. So let's just say, man, they actually, where do I get a text here? How do I get back into that? So, okay. I don't know how to actually reselect that. It's okay. So I'm going to go to here. Move that over a little bit. Move this over a little bit too. And I'm going to say, okay, so let's just say that they purchased a home for $200,000, let's just say, okay? They didn't need much bigger house than what they already had. So they purchased a home for $200,000. How much more of their entitlement did they use? Anybody got any answers? You can unmute yourself and say it. If you want to type it in, you can. I just can't see the text right now.
50.
That's exactly right. They used 50,000. Now tell me how you got to that, John. You can unmute yourself.
I paid attention in math class. No, I'm just kidding. 200,000 times 0.25.
Yep, that's exactly right. So, so the entitlement used was 0.25% of. It's not 0.25%, guys. Just know there's a difference between 0.25% and 25%. So, it's 0.25 or 25%. So, I think there was a YouTube video came around with Verizon had an issue with this years ago. I don't know if you all saw that. It's pretty funny. The guy couldn't understand that they had quoted a 0.02 cents for every minute, and they couldn't understand that 0.02 cents is actually 0.0002. The person really was struggling with this. It was pretty funny. Okay, so so entitlement was 0.25% or 50,000 is how much they used their entitlement. So now the question is, how much entitlement do they still have left over?
32.6.
32.6. That's exactly right. And the way we did that is we looked at the entitlement they had after buying. And in all these situations, this is assuming they have not resold the house. This is assuming they just kept the house that they had. Is 82,000, which is what we had up in this area up here. Oh, can I not? Well, that stinks. Let's see if I can go back to it. Well, for some reason, it won't let me get back into the old ones. Like once I retype that, and I'll just make it. Okay, so it was, let's see, 50,000 is what we, so it was 200,000 purchase price. And that uses 50,000 additional entitlement used. But now let's remember, the customer had, or the veteran had 82.6 left, so 82,600 left in entitlement. So if we go to 82.6 is what they had remaining, and then they subtract out that 50,000 of entitlement that used for this $200,000 purchase, we were left over with 32. Was it 32.6? Is that what it was? 32.6. Yeah, 32.6 is what's remaining. Oops, not 5. 6 remaining entitlement. Okay, so that's how much they have remaining. Now, keep in mind, they own 2 houses at this point and still have 32,600, not 6,000, all thumbs today, remaining. So now here's the question: how much entitlement? How much of what does that translate into? 32,600 remaining entitlement. What does that translate into loan amount? Anybody?
$130,408.
I think that's right. 32,600 times 4. Yeah, 130,000. So the customer could still purchase. I'm going to change that a little bit. Home key home.
130,400. Sorry about that.
That's right. 100%. Okay, so they could still buy a home for $130,400 and still use 100% financing. So, like, it's feasible that they could. Let's just say they were downsizing. They're like, man, we about this bigger house because we had kids, and we kept these homes, and now we kind of want to get into a smaller house. They could theoretically buy $130,000, or mathematically, I should say, buy a $130,000 house and some change, and still use 100% financing. So that's 3 homes that they were able to buy. 3 VA loans that are all at the same time to obtain 3 homes, all of which they had 0 down payment for, which is pretty phenomenal. So you guys kind of see that. I'm going to pause just for a second. Any questions on that? Does anybody have any questions on the math in this? Because this is key for understanding, like, when a customer can use 100% financing.
I have a question.
Yeah, go ahead.
This is John. Obviously, they have to go through underwriting. If that former primary house has a signed lease, and does that go into the equation of the underwriting, or do they, or I guess my question is, I think in conventional, maybe FHA, you're the expert, not me. If you have a signed lease, then it doesn't get counted into your ratio. That's what I was trying to think of the word. Help me out there.
Yeah. So it does get, it gets counted, but what you're saying is right. The gist of what you're saying is you can use that payment then to offset. So whatever the lease is, you can use 75% of that lease. VA is the same. So you can still use rental income if you've got rental income to offset the payments on another mortgage. So if you had a lease agreement on these 2 homes, you could use that rental income to offset the payments.
I think we got a market here we got an underused market, man. Holy moly.
You're absolutely right. You're absolutely right. I actually, I for a while there, I was set up with some people in Albany. And Albany has a marine logistics base over there. And so I did a lot of VA loans. I helped them close some stuff that Veteran United turned down. And Homestar is very aggressive with VAs. And I've just done enough to where, typically it's, I'm good at making points to underwriters because I did it for so long. So that's kind of where I've just grown. And I got some really kind letters. I had a pastor that I did a loan for who was a veteran that, man, that was very tough. I had to use, it was tax returns and having to add stuff back. And you're talking some high level underwriting that you had to use to kind of justify the income. But Homestar is willing because they understand. I was doing the training for VA as an underwriter, and I'll never at Wells Fargo, and I'll never forget the person who was doing the training just saying, VA really wants to get their people into loans. They really want to help them get into homes. And I think when you think about the guidelines from that perspective and not like, hey, the guidelines are there to try to keep people, make sure that the wrong person doesn't get into the house, like that's the wrong mindset. But instead thinking of it as, hey, VA wants to get their people in homes, you start trying to figure out ways to make the loan work. Okay, let's look at the good parts of this. And Homestar is definitely on board with that. I've got a VA contact that I know from Wells Fargo who apparently is real high up and has had conversations with our underwriting manager. And, to me, he's just the guy that I worked with before. But from Homestar standpoint, they treat what he says as the gospel, I guess, because he's been at the VA for some time now. So that's been real helpful because he's just been awesome. He's an awesome person to have and just somebody who's really I listen to and love to pick his brain about stuff. So anyway, okay, so let's get out of that. So entitlement, I'm going to stop, see if anybody typed in any questions here. What happens to having the home's owner occupied? Mila, will you elaborate a little bit on that? So when you say what happens to having the home's owner occupied, so you can buy.
You already have 3 homes. What happened to the 2 other homes? You can only occupy 1 home at a time.
Yeah. So, okay. So that's a very good question. That's kind of what I was talking about before is you can't finance the home as a primary, as an investment property, but you can, once the kind of the rules are with treating a home as a primary residence is you have to live in it for a year because obviously you can't know where you're going to be in 2, 3, 4, 5 years or whatever it is. So they just say, look, within the next year, you need to be living at the house. So if you've lived in it for a year, you've fulfilled the primary residence. And what you do after that, you can, sorry?
That's all that's required. You can basically rent the rest of the homes that you have.
Yeah. So once you've lived in it a year, I mean, obviously, people, they move, and if you keep that home, you would basically just be turning it into an investment property. Now, again, what you can't do is go get the financing knowing that it's going to be an investment property. Like, in other words, you can't get it and say, hey, I'm renting this thing out tomorrow. Like you have to be planning on living in the house for a year. So,
okay, thank you.
Yeah. So to answer your question, and that makes sense, the 2 previous homes would be considered investment properties. They just didn't finance them as investment properties. They bought them as primary residents, but then ultimately turned them into investment properties. And you can refinance those. That's actually an exception. And not a lot of people know that FHA, you can actually refinance an investment property FHA. I have actually done that before. I had my first home that I ever owned. I kept it as an investment. I still have it as an investment. I had it as an FHA loan. I had like a 3% interest rate, which back then was like unheard of. I'm sorry, I could refinance into a 3%. And I was able to do a streamlined refinance. And even though I didn't live in it, I moved out of it. We bought a bigger house because, like I said, all the kids. And rates got lower, and I refinanced it as a streamlined FHA refinance on an investment property. But I didn't buy it as an investment property. They just allowed me to do a streamlined refinance because I had already had the home. So it's kind of an interesting little tidbit.
That's done all the time.
Okay. Yeah, absolutely. Okay, let me see what else we got here. Aren't you in default on the primary loan then? You're no longer living in it? No. No, like I said, and I think I just answered that, Kathleen. So I probably should have read top to bottom on the questions. So no, you're not in default on it. You fulfilled your occupancy obligation of a year. So now, yes, Mila, my reader name is kind of small. Mila, you're absolutely right. That will require 3.3% funding fee. So because it's the subsequent use. So for the other 2, you would actually have a 3.3% funding fee just for a regular military, obviously. Actually, that's for both military because it'd be subsequent use. What thing to finance the front fee? Yes, almost always that front fee is financed. Almost always. So it's always allowed, and it almost is always done. It's very rare that you see them paid at out of pocket. They can add into the loan. Yeah, okay. Sorry, you were answering that question for. What happened to having the homes? Okay, got you. Can use VA loan to purchase a multi-unit if they will reside in one of the units? Yes, you may. You can do a 1 to 4 unit. And you can use that rental income to qualify also if you have a lease agreement for it. So you're absolutely right on that. You're correct on that, or the answer is yes on that. So, the question was, can you use a VA loan to purchase a multi-unit if they will reside in one of the units? And the answer is yes. That is considered a primary residence. So that's like a really cool thing, by the way. Something I wish I had thought to do like early on, but when I first bought my house, I wasn't thinking investment properties. As I've gotten older, I've realized, hey, I need to, I kind of want some more investment properties. I mean, who would have thought we'd be able to borrow money? Like, money's so cheap right now. You know, I mean, you can borrow money for like between 2.5% to 3.5%. I mean, that's just like unheard of. And I was talking to one of my friends who we do a lot of investment stuff together. And we were just saying, you know, I think we're going to look back on this in a few years and kind of wish we had maybe extended ourselves a little bit, you know, because I just don't know that there's ever going to be another time like this where rates are so low and money is so cheap. Okay, let's go back to screen sharing. And you present. Okay. So went over here a little bit. C10 sales price. We kind of went over all these. I'm not going to go over anymore because we already did this. So even if the buyers are both eligible veterans, maximum guarantee is not increased. So in other words, you don't get to double up for both people being veterans. Now they could buy homes individually, and then they would be able to use additional entitlement. So the veteran buys a home with non-veterans other than spouse. Guarantee only covers veterans half of the loan. Veterans can finance part or all of the down payment required by the lender if the combined loan amount, the combined loans don't exceed the notice of value (NOV), which is the appraised value. That's all it is. So in other words, if they wanted to do a down payment, they could finance it. But the thing is, there's not really down payment needed. So they have real weird rules. And I guess if you wanted a lower funding fee, then you could do a down payment for it. Buyer qualifies for combined payment. I should say on jumbo loans, you would need a down payment. So buyer qualifies for combined payment, and the secondary loan is assumable by creditworthy buyer. Secondary financing can't be used to cover the down payments required by VA because sales price exceeds the value. Lenders use standards established by VA to analyze veterans' creditworthiness. So we're getting the credit a little bit. Income ratio method and the residual income. So this is where we're going to talk about residual income, which is something that really only VA uses. FHA uses a little bit as a compensating factor, but not in the same capacity that VA does. FHA is only if it's needed to justify higher debt to income ratios. And you can use it as a compensating factor to do that, but it's one of a list of compensating factors. VA requires it. VA uses debt to income ratios to analyze the income of loan applications. The ratios generally shouldn't exceed 41% unless they are compensating factors. Debts with more than 10 payments left after are counted as recurring obligation. So what that tells you is debts with 10 payments or less don't have to be counted. So if you've got auto loan, you have $2,000 balance, your payment's $400, you don't have to count that payment in there because you're going to have that thing paid off in just a few years. I'm sorry, in a few months, not a few years, sorry. VA underwriting standards are merely guidelines, not hard, fast rules. So I would say, again, they're not guidelines. They're guidelines, they're not exact lines. Compensating factors may allow loan approvals in spite of weaknesses in application, but compensating factors must be relevant to weaknesses. And what that means is if your debt to income ratios are high, you can't say, well, yeah, but their credit is great. They've always paid their mortgage. Well, that doesn't really, what they want to see is you've got some assets there, or maybe you've got some like good residual income or something that has to do with the income piece of it, not just your credit. Possible compensating factors: excellent long-term credit history, conservative use of consumer credit, minimal consumer debt, long-term employment, significant liquid assets, and sizable down payment, little or no increase in housing expense. That's the big one. And then military benefits. Additional ones, satisfactory previous experience with home ownership. So in other words, if they've got years of owning a home, and I mean, we can look at that, they'll use that as a compensating factor. There's a lot more compensating factors with VA than there are with FHA. Again, it's indicative of VA really trying to get their people into homes. High residual income, low debt to income ratio, tax credits for child care, tax benefits of home ownership, significant equity in the property for refinancing. So special rules for approving applications whose income ratios are over 41%. Ordinary lenders must submit detailed statements to VA listing compensating factors, which the underwriter does that. But if the residual income exceeds the minimum by 20% or more, loan can be approved even though the income ratio is over 41% without any compensating factors. So your debt to income ratio is over 41%. Notice there's no limit there. It doesn't say you can go up to. It's just if it's over 41%, you can still do it. And that's where I say there's really no max debt to income ratio. So, and for any new realtors out there, what I mean by debt to income ratio is simply that. I mean, it's just your debt divided by your income. So, and when I say debt, I'm talking about things like things that you've borrowed, not monthly payments like utilities. Utilities is not debt. That's something you're paying for monthly service that you can cancel if you want to. Debt would be like credit cards, auto loans, installment loans, mortgages, these kind of things. So you can actually go up if the residual income is more than 20% of what's needed. So in most areas in the Southeast, it's tiered by region. The residual income needed is $800. So if it's $840 or something like that is what you need to have. And what do I mean by residual income? So what I mean is residual income is the amount of income you have left over after you paid all your bills. And this is not just your credit that your debt that you have, your minimum payments and your debt. What it is, it looks at at more of your net income. So they try to take into consideration what your taxes approximately are going to be. And there's a calculation they use for that. They back out what your utilities should be. They base it off square footage. There's a certain calculation they use. And then you could add back child expense. That's one thing you can add back. And they try to figure out what your true income is, what your true take-home income is, and then back out all your, I'm sorry, they have to count against, I said add back. They have to count against any child expenses. And then they try to figure out how much money you have left over after you pay your bills. So obviously somebody might have high ratios, but let's just say, their ratios are 50%, but they make $8,000. Well, that's still a lot of money left over, and you only need like roughly it's 800 times 20%, whatever that is. I think it's 840 to be exact. 840 times 0.2, actually times 1.2. So you need to have $1,008 is what you need to have in residual income. So most people I find, I can get that. Most people I find do have that. So, okay. Special rules for approving applicants whose income ratio is over 41. We already went through that. Okay. So residual income analysis, also called cash flow analysis, is the second method used to qualify loan applicants. So it's a gross monthly income, taxes, reoccurring obligations, housing expenses, residual income. Vet's residual income should be at least $1 more than the VA's minimum requirement. So I guess they have to have $1 more than the amount that's listed. Minimum requirements varies according to the region of the country, family size, and size of proposed loan. Like I said, it's normally in our area about $840. As your family size goes up, it increases though. It's tiered. I'll see if on the break, I'll see if I can, I'll try to pull up the VA website. And then I'll try to show you guys that so you can kind of see. Okay. In the 640 mid-credit score range, let's see, underwriting guidelines, residual income. No, go back here. Give me 1 second. Okay, I'm going to go through this AU referral stuff, and then I think we're going to break for another 15 minutes, and then we'll finish off. The AUS accept for VA loans. So AUS stands for Automated Underwriting System, and when you get an accept for a VA loan, then we're good. So in a 640 MIDS credit score range, accept gives credit clearance with waivers of certain derogatory issues. So you don't have to get any credit explained or anything like that. An AUS accept does not mean the loan is clear to close, but it does tell us that, hey, look, we've got a really good customer here and things are looking good. So we just need to verify all the information that was used to get that automated underwriting approval. So, you know, things like we put in their income, we know the credit is good because it pulls directly from a credit report, but the income is just what we put in there. The assets are just what we put in there. So we need to make sure those things are exactly what the documents support the numbers we put in there. Veterans must still meet debt to income ratio and residual income factors. So the residual income still applies in there though. What we consider for approval. So VA is a little different. Like FHA typically looks at the last 24 months and it looks at the last 24 months heavily. If you've got 24 months of on-time payments with, you know, no bankruptcies, I should say no foreclosures, no bankruptcies in there, generally you can get an FHA loan. With VA, it only looks at the last 12 months. So 12 months is where it looks at. The collections account, are they minor or are they major? Typically, you don't have to pay off collection accounts unless it's something just absolutely major. Charge-offs, how much and how long ago? Federal debt. So you can't close, like we mentioned before, if you have any unpaid federal debt. So anything that's in delinquency that's federally owned, better pay it off somehow. Judgments you can't close without with open or unpaid judgments. And the absence of credit history, that's something to look at. But again, we can get non-traditional credit if we need to. Okay, so we're gonna go into bankruptcy. Let me see if there's any questions here. Okay. Your light went out because somebody said their light went out. I don't know what that means. Can you use VA to purchase a multi-unit? We already talked about that. Okay, it's fine. Okay, so no real questions. So let's break here. We'll break for about another 15 minutes and we'll come back. And I'm going to try to go and do anybody got any other questions? We're good to this point? Everybody's okay. Let's take about a 15-minute break again. And then I'm going to, there's a couple of things I want to check in. I'm going to try to pull up the VA guidelines so that we can kind of look over that together. You can see what that looks like. And yeah, that's all. So be back in 15 minutes. Doing, buddy?
Nothing. I was I had to cut some of the out to chop gold and wood, and we had this pallet that I'm all wearing to chop up all over them. And those things are not easy to chop. You have to like slice them down the middle. You can't like cut them in half. Like with the hatchet that I'm using, you have to just like fold them in the middle, and then I chop it down from there. And when you get them thin enough, then you can slice them down the middle.
Well, probably proactive, man.
Yeah. Why are you doing your stuff in here?
No, great. I'm teaching a C course. I'm just trying to have a wall that I'm not disrupting Dustin. And then once this is built out, it'll be a lot better. I might even build me a little place for doing these. I have a little bit of background.
We can hear you, Dana.
Oh,
Dana.
sorry about that.
That's all right. I just thought I'd let you know we can hear y'all. It's okay as long as you don't care.
Well,
All right.
I appreciate you. Yeah, I'm glad I didn't say anything. Oh, this class
All
is
right.
the worst.
Oh no, I'm enjoying it. I'm learning. I'm not
Okay.
a first time realtor new, but I'm learning and I appreciate you.
Yeah.
Thank you.
Yeah, I get that a lot in this class too. That people will say that, hey man, we really learned a lot. And I think, like I said, I think that's why I like VA as much as I do, because I feel like people are just like, man, this is really neat. So obviously it helps when the content is helpful. So.
Right. Well, I have a question about, I have a niece who's VA and I sold her a house. But anyway, take your break and talk to your children. I just
Okay.
had it where I could still hear when to come back. And I thought, I wonder if he knows that we're listening to him. All right.
That's funny. I forgot I put my phone down. I took my earbuds out just to charge them so they wouldn't go dead like with the last half hour of this. But like I said, all my tools are down here in this room because this is where I'm doing all the remodeling. And so my son had come down. It's always a little concerning when your 12-year-old like walks out with like a hammer and a pry bar. You're like, hold on.
Listen,
what are you doing?
I used to be in kindergarten. I was a kindergarten teacher.
Okay.
So I know
That's
about kids, but you're going to have to give me my 5 minutes back because I'm calling my clients while I have my 15-minute break, but I kept you turned up so I know when to come back.
Okay, got you. I'll let you get to it.
But that's all right. I love that you're personable. That would make me use you over a lot of people. I don't care. So
yeah, well, give me a ring. I'll put my contact info in there because I love helping people. I really do. But I'm much more of a people person than I am a salesperson. Like that's kind of how I've gotten my business, is just because I genuinely enjoy like working with people. I'm not like an introvert at all. But yeah, it's one of those things that it's so hard to be personable. I feel like on these Zoom ones, but you just kind of got to do what you got to do. And, that's kind of what,
well, listen, I've been told, look, a lot that you talk all the time, you talk too much. And I do, I'm just like my mother. But, as a realtor, I have a little story. I used to be a teacher and I said, because I love children back in the 20s. Then I came to the airlines and I said, I like people. But now I'll just say over 60 something. I say I have to stutter about all of it. But you have to love people, and a people person is good.
Agreed.
Now I'm proud of it,
Yeah. I think
It'll
it's a good
take
thing.
you.
I think, yeah, that's great.
All right. Now, did we talk the whole 15 minutes?
Nope. We got a little more time.
I'm teasing. I can hear you when you start. All right.
Okay. We got about 10 minutes.
I'm gonna mute myself.
Okay. All right, everybody. We're gonna go ahead and start back here. Let's keep looking. Okay. So I did find, I'm gonna see if I can share this screen. I think I can. Yeah, looks like I can. Okay, so this is the VA guidelines. So there's some neat things here that I want to talk about. First would be what is that? Residual income. Oh, I guess I should spell it right first. Residual income. Okay, so residual income. There's a remember we talked about it that it's tiered, and here is the tiered box. So this is for loan amounts that are 79,000 and below. So you're not going to really use that a whole lot. And then if you go down the next page, somehow there's a way to go to the next page. There we go. This is the box you'll use more than often, which is for $80,000 loans and over. And you can see if the family size is, we'll say 2, it's 738 in the South is where we would be. 889 for a family size of 3, 1003 for family size of 4. I think I said 840, but I'm so on remembering like numbers. Guidelines change so much that I always look it up. And every time I have the loan, I always go in the guidelines and look it up just to make sure, because it's just better to do that, in my opinion, than to botch it. So that's that. I also want to look at the funding fee too, because this is where all the information is, where we get the rules. So this is the VA guidelines. So funding fee, and this is where keep going through. I'm going to go down pages here. There we go. Okay. Stat funding fee for regular military. If we said 2.15%, 3.3% for subsequent uses. If you're putting more than 5% down, it's only 1.5%. And it's 1.5% for subsequent uses also. And then 10% or more, it's 1.25%. So, and here's the grid for the reserves and National Guard. So I just wanted y'all to see that so you can kind of, just so you, I don't know, could see what we're looking at. But, okay, I'm going to stop sharing that. And then I'm going to go back into, okay, bear with me just one second. Going to this. Okay. All right, let's get back into it here. See if there's any other questions. Okay, so we're good there. And share screen again. Let's go back into our slides. Okay, so we're going to get the bankruptcy, what the bankruptcy requirements are for VA. So you have to be discharged for at least 2 years on a Chapter 7. So Chapter 7, Chapter 13, for anyone who doesn't know, is Chapter 7 bankruptcy. You have those bankruptcies are for is where you're basically just forgiven of all your debt. So there's no repayment, just hey, I'm done. So there's generally a longer requirement for that because there was no like attempt to pay the debt. So for Chapter 7, you have to have 2+ years from the discharge date. So they would ask for the bankruptcy papers, and then they would use those bankruptcy papers to determine if you've been over 24 months. So now there's an exception for that. If it was some sort of circumstances that were beyond the customer's control, then at that point you could actually do it with only 12 months of a period. So what would constitute something being out of a customer's control? Well, a car accident, a medical thing, something like that. Those are the kind of things that they would consider to be something that that's not your fault. You just couldn't happen. But it would have to be something that showed a loss of income that was beyond your control. Typically, divorce, they do not count as a reason. So you must have documentation to support anything really in the mortgage industry, and it must have reestablished credit for the most 12 months. So you have to have other things that you've been paying and showing that you've been managing credit properly for 12 months. Bankruptcy on Chapter 13. So Chapter 13 is a little different. Chapter 13 is where you actually make a payment plan so that you can pay back your debtors or the people who you borrowed money from. So there was an effort to pay, and so it's viewed as acceptable if you've been in if you got a 12-month history of it with no lates, and there's an acknowledgement of the trustee or agency saying that yes, it's okay. And the reason for that is they need to basically give the thumbs up on, yes, you can still apply for a loan even though you're in this Chapter 13 bankruptcy, because they want their mindset is, okay, hold on, you're having a hard time paying your bills, but you're going to go and try to get yourself into more debt, So they need to be able to make real good sense of it. And something that would make sense would be, you telling them, hey, you know what? Like, yes, I'm buying a house, but my rent is $1,400 a month. My mortgage is going to be $1,300 a month. So I'm putting myself into a better financial situation. So it just have to be something that makes sense. I can almost promise you that if you're, paying currently $1,100 in rent and you're going to be taking on a $1,600 mortgage payment, or in the middle of a Chapter 13, you're going to have some difficulties getting the acknowledgement from the trustee who's doing the Chapter 13. Foreclosures. Develop facts about the circumstances. Hey, what happened? What led to the foreclosure? And it needs to be something that makes sense. And the same waiting period as Chapter 7 bankruptcies, that's 2 years. That is different from FHA. FHA is 3 years. Conventional is 7 years. So VA has the by far the most lenient the foreclosure time out of all the programs. Prior VA loan. So you got to, with the prior VA loan, you have to ensure that no debt to the government and the entitlement has been restored. So if you foreclosed on a VA loan, there can't be any debt owed to the government, because you're going to get a CAVRS hit when you do that, and you can't do a government loan if you have a CAVRS hit. Debts and obligations. You may remove debt within 10 month payments remaining, because we talked about that before. You don't have to count anything with 10 months or less, and that's with installment loans. Only monthly revolving and installment accounts considered. Child care is a monthly obligation, so you have to count that into the debt to income ratios. Investigate all allotments on the LES, which is leave and earning statements. It's just a pay stub that veterans get. Verify and consider alimony and child support. So all of those things we have to count into the equation. Things you may disregard, things that have been co-signed with someone else. Now, if you've got a co-signed loan, typically 12 months is needed. So you need to make sure that you have 12 months of showing someone else has made the payments. Something that's tricky with that is I'll see this a lot where, somebody says, well, no, my son's paying. That's a car I co-signed on with him. He pays that. And what really happens is the son pays the dad, and then the dad pays it out of his account. That is incredibly hard to verify. So it needs to be something where the son or whoever the co-signed person is paying it directly to the debtor. No reason to believe the applicant would need to make the payments in the future. So it's got to make real good sense. Student loan payments deferred 12 months or more. That would be another thing that that's again contrary to what FHA and conventional does nowadays. You can actually exclude anything that's deferred 12 months or more. It's kind of like the old FHA guidelines. And that's student loans that are deferred. 401k loans. 401ks loans, there's no loan program that I can think of that makes you count 401k loans. And the reason is because they just understand that a 401k loan is just loan borrowed from your own money. I mean, that is your 401k is yours. So there's not, it's not like it's like debt that you owe to someone else. So VA loan amounts and underwriting, down payments, secondary financing is just kind of everything we went over. Income ratios analysis, residual income analysis, and compensating factors. Do we have any questions from there? Let me go back to sharing. Any questions? Like layoff, tell me what you mean. What would be layoffs? Oh, I'm sorry. I missed the first part of it. Patty, I got it. Had a short sentence. No, okay, twice too glad. That's fine. Okay. Tell me what you mean by the layoffs piece of it. Anybody? Okay.
I'm
right.
sure she's talking about laid off, like the pandemic, and you got laid off of work and you got behind.
Yeah, but in relation to what? Is you talking about your debt to income ratios? So if you have, obviously people were forced to not work, for a period of time here. So this is like a very interesting or unusual and never seen before type year. So it will be consideration that will be made to people who maybe their year to date is a little low. Those kind of things should be taken into consideration, because what the lender is concerned about is what in the future is going to happen, not what in the past has happened. They just use the past to try to figure out what's going to happen in the future. Obviously, an isolated incident like government shutting down things for a certain period of time, that's not something that you're thinking is probably going to happen over and over again. Hopefully, it doesn't happen again. But let's see. Okay. So I'm gonna get back into it when you mentioned uncontrolled. Oh yes, uncontrolled situations. Okay, I understand now. I'm so sorry, Kimberly. Yeah, so they're asking. Kimberly's asking about things that were beyond your control. And yes, the government telling you shutting things down and you losing your job because the whole economy shut down. That would be something that is beyond your control. That would absolutely be a good point. Okay. And I suspect that's something that we're going to see in the coming years, as people are coming out of these things. Hopefully not too often. But
I have a question.
Yes.
I have a client that had 2 foreclosures on the VA loan, and it looks like, looking at his certificate of eligibility, one was in 93, one was in 09. So I'm reading on here and it says the veteran is eligible for a home loan, 37, whatever. It says entitlements available to the veteran is 36,000. So,
yeah.
So that's what he can use.
Yeah, that sounds like it. Now he can't have any debt that he owes to the VA. So if he hasn't made good on that, on his entitlement, then at that point, they're going to have a CAVERS hit, and that's going to become problematic. But it sounds like from there, I would think that would show up on the COE if that was the case. And the timeline has
it looks like it's saying he just got it October the 12th, and then it says down here, I guess he has exemptions too. It says the veteran is exempt from funding fee due to the recent service connected disability of $1,200.
Yep.
$1,235. So he said he made it good. So how would I know how much home he can buy from this though?
Well, if you want to, so what we can do is if you want to call me, we're offline. Again, before I leave, I'll put a comment here with my contact information.
Okay.
but if you could, if you give me a holler, and what we can do is we can try to pull a Cavers on him,
Okay.
and then we can. What I'll need is his social, date of birth, and his full name, and then I can have my processor pull a Cavers, and then we can see if there's anything showing up. That'll tell us for sure if there's any hits on there. So,
Okay, gotcha. Thank you.
But yeah, no, it's a good question. Okay. Special circumstances for prior approvals. Joint loans. Vets in receipt of non-service connected pension. Vets rated incompetent by VA. Interest rate reduction loans when refinancing a delinquent loan. So there we go. Prior approval. Lender that originates the loan. So prior to the loan being approved, the originator will originate it. That's what I do. I'll look at the credit. I'll look at the income compared to the credit. We'll run the AUS, which is the automated underwriting system, and then make sure that we have a viable loan. I'll look at the residual income, make sure the residual income is there, and then we'll gather all the supporting documentation. So when we gather documentation from the customer, by the way, all we're doing is we're just trying to document everything that they put on the loan application, because nothing is taken for word, everything has to be documented. So what we do is we get in there and we say, okay, well, you said you made this much income. Let's verify that, and we get W-2s and pay stubs. You say your birth date is this. Let's get a driver's license to verify that. Let's get a driver's license to verify the spelling of your name. Let's get some bank statements to show that you have enough assets or whatever it is. So all those things have to be verified. The credit report verifies a lot of the information. So we get all that stuff up. We put it in a nice, neat package. We send it over to the processor, and all this is done paperless at this point. And we send it over to the processor. The processor processes the loan. They send it to the underwriter. Underwriter approves it. Once we get the clearing close, they submit the loan to the VA for underwriting. And it closes after the VA issues the commitment, usually in 3 to 5 days. Now, when you have a VA approved underwriter like Homestar does, you don't have to wait for that process of it going to the VA. What's changed at VA regarding appraisals? 40% increase in the number of appraisals in all states. There's been a huge influx of business, as we all know, and this has created somewhat of a backlog for appraisals and appraisers. But this is not VA specific. This is every loan specific. So the VA has actually done a pretty good job of kind of foreseeing this and ramping up their appraisers. All appraisers must be e-commerce compliant. Appraisers are expected to communicate with all parties. The lender appraisal process processing program. Timelines, issues aggressively monitored. So these are all things that they look at. And they're doing that because they got a lot of complaints for a lot of years about VA appraisers. Like I said, I haven't really had too many issues with VA appraisals. I know that's a kind of a stigma that they get, like people just kind of cringe when they think VA because the appraisal. I have not experienced that. All my values have come in just fine. Again, anecdotal, I get that. I don't really have any charts to kind of show. I think that'd be some hard analytics to come up with. But inside the lending business, I haven't heard a lot of issues. It's more from people that I think have just kind of heard over the years of their issues. So I think the VA has fixed a lot of the concerns that people had. Minimum property standard. So it's got to be safe. There can't be any kind of safety concerns, whether it be structural or electrical or all that stuff. It has to be sanitary. So if there's a well, they got to get a water test to make sure the water's good. Septic test. Sound. It needs to meet all local and county structural building codes. Bottom line is no fixer-uppers. If you bring in a house that doesn't have carpet, it's got walls, holes all through the walls, and this thing's just been torn up, you're probably not looking at a VA loan. You're probably looking at an FHA or possibly an FHA 203K loan. We are working on doing our VA rehab loan. That is a loan option that VA offers, and it's one that I've been trying to push for at Homestar. So I think that will be coming here probably in the first of the new year. So the notice of value, this is what the appraiser issues once they're done with the appraisal. And it just basically says what the value is. So it works just like the appraised value. The borrower has to pay the difference. And we talked about this before. If a home is selling for 200 and it appraises for 190, that means the customer has to bring that additional 10,000, or they have to renegotiate. You can always renegotiate with the listing agent and say, hey, you know what? The house isn't worth 190. I did that on my first house that I ever owned. I think it was like 155 is what they were asking for it. And it came back in at 150.15. And the listing agent kind of gave me some grief about it for a little bit. And I just finally told him, said, look, I'm willing to give you full value for this house, but the house just isn't worth what you're trying to sell it for. So, and again, it's not like appraisers back then, of course it wasn't, but nowadays you can't even talk to appraisers. HPCC guidelines, which is Valuation Code of Conduct, you can't influence an appraiser at all. So back in the day, the appraiser works for the loan officer. So you just tell them like, hey, get this value. And if they wouldn't, the loan officers would just go and get another appraiser, which was not good. And what it led to is values being pushed and probably inflated home values. So borrower has to pay the difference out of pocket if the NOV is lower than the sales price. Basic rules of VA loans regarding occupancy. Let me check real quick and see if we have any more questions. Bear with me. Let's see. Okay, I lost my Zoom meeting. Here we go. Situation cannot work. VA appraisers are just straight to the point. They just don't talk. Yeah. They say that's exactly right. Yeah, I think it is. You're absolutely right. I imagine that appraisers don't really talk to people a whole lot, and that's not good for the human psyche. So when they come to your house and they seem, not like real friendly people, I've found that most of them tend to be a little more introverted and a little more analytical. So I can't blame them. I can relate. I have a very analytical side. Obviously, I was an underwriter for a lot of years, but I also have a very social side of me. So, like I said, I generally can relate to most people. All right, let's get back in here. Nope. Screen sharing. Now let's go to present. Okay. Basic rules of VA loans regarding owner occupancy. So generally must occupy within 60 days of the house. So we talked about that before. You can't buy the house and be like, yeah, I'm going to live in it in like 3 years. Like that's not how this works. You have to occupy the property within 60 days of closing. The exception, and there are some exceptions. Obviously, we know military people are called on service for a lot, and that's where the spouse can satisfy the occupancy. Also, we talked about this before. IRRLs do not have occupancy. You don't have to occupy. I'm sorry. So you can do. That's where I mentioned before, just like that FHA refinance that I did, where I bought it as a primary residence, but then I turned it into an investment. I was able to refinance that, and it didn't matter that I didn't live there because it was just a streamlined refinance. The same thing with an IRRL. Now, I want to make a distinction between an IRRL, which is an interest rate reduction refinance loan, and a refinance. So you can refinance anything that's not an IRRL is considered a cash out refinance with a VA loan. So if you're not doing one of these, then you do have to have it would have to be a primary occupancy. But with the IRRL, it can be an investment home, a home that maybe you bought as a VA, and then in the scenarios that we mentioned before with the entitlement, where you bought another house and maybe even another house, you could go back to that first one and just do you just wanted to lower your interest rate, you can do that, and you not necessarily have to occupy it. So it kind of goes back to that thing, John, we were mentioning before, where, man, there's a market there to get people to tell people, hey, you can really build wealth and accumulate properties using this VA thing. Oh, and by the way, if the market changes on all these investment homes that you have that are VA, you can also do these IRRLs. And I'm telling you, all it is, it's a loan application. That is it. You literally send the loan application and then you're clear to close. I mean, it's crazy how easy these things are. So. If the veteran is on active duty, they must occupy within 12 months. So remember I said that they'll when you get called on the duty, it's fine. That would be an exception. You just have to occupy the property within that 12-month period. So it's a little more lenient again. So, okay, contract issues. Contingent on VA financing. The escape clause is mandatory. Seller must pay termite inspection. So there are certain fees that the seller, that the buyer can't pay. Seller must pay the termite inspection. It's neat the way it does it. So what VA says is that you can, for closing costs, so for seller concessions, it says that you can contribute 2% plus closing costs. Well, normally what people do is they just see 2% and go, oh, that stinks. The seller can only contribute 2%, but it's 2% plus closing costs. Well, I think we all know that closing costs make up the vast majority of your total costs, they make up more. So I'd say like on a $250,000 loan, you're probably talking about $4,000 of closing costs, and you're talking about an additional $2,000 to $3,000 of prepaids. So you could pay all those closing costs and then an additional 2%. And now that 2% could be in the form of a discount, could be in the form of the prepaids or whatever. Not a lot of people know that you can actually pay down people's debt with VA. So the seller can actually pay down the customer's debt. Part of that 2% they could use. Let's just say they paid all the closing costs and they were good and they wanted to pay down the customer's debt or a tax lien or something like that. You could actually do that. So it's kind of neat. A bunch of stars. I don't know what that was for. Okay. Allowable fees and charges. So you can, the appraisal report, that is something that is allowable fee, and compliance inspections, a credit report. It's basically the same fees that you're going to see on any other one. There's a couple exceptions, and we'll go over that in just a second. Prepaid, taxes and insurance, title exam, and I'm going to go over prepaid real quick, what that prepaid is. Some of you guys know this, some of you don't, but I'm going to take some time to explain that. Prepaids are generally your taxes and insurance, and then your prepaid interest. So what is prepaid interest? Mortgages are different than rent. Rent, you pay for the month that you're getting ready to stay at a house, typically. Mortgages, the mortgage payment is paid in what they call arrears. So what that means is your mortgage payment is paid after you actually lived in the house. So when you make a mortgage payment on, we'll say December 1st, you're actually paying for the time of the house that you were in November, okay? So what prepaid interest is let's just say we close this month, and I'll just say today's the 10th. So there are 30 days in November. So what the lender does, they say, okay, we're closing in the middle of the month. Your first real payment is, since we collect full month payments at a time, your first payment is going to be paying for December, because that's the first full month that you lived in the house. And that payment won't be due until January 1st, because you're always paying in arrears. So, but you close November 10th. So that leaves 20 days in November that are unaccounted for. That you had this home, you had a loan, and nothing has been paid. So what they do is they collect per diem. They have the per diem interest, and they collect from the 10th on this scenario all the way to the 30th. So that's 20 days of interest that they collect to make sure they've accounted for the portion of November that you own the house. And that's what prepaid interest is. So prepaid interest, taxes, hazard insurance, those are your prepaids. When you hear a lender say, oh, your closing costs are $4,000, your prepaids are $2,500. That's what they're talking about. So title exam and title insurance fees, flood zone determinations. A flood zone, every lender pulls a flood cert, and that just tells you that that the house is not in a floodplain. If it was in a floodplain, they also call them elevation certs. They're trying to see how high above, I guess, sea level that the house is. And if it's too low, then at that point it becomes in a flood zone, and the owner has to have flood insurance. Environmental endorsements. Oops, didn't mean to do that. Go up. Okay, 3.0, 8.1, 103.5. I guess those are things that title. Those are different title forms, but these are things that are allowable fees. Recording fees and taxes, EPA endorsement, the origination fee, and a reasonable discount point. So you see that there's origination fee and there's discount points. These are two different things. Discount points are, and notice it says you may roll up to 2 points into an IRRRL. Discount points are points you actually pay to lower the interest rate. Okay. So if a customer, you can always, there's not like one interest rate every day. That's kind of a misconception that people have. They just think like, you know, you'll have customers ask a lot, hey, what's the rate today? Well, there's not a rate today. There's a series of rates today. It just depends on how much money you want to pay. So now there's a par rate, which is a rate that does not cost anything and it does not charge anything. I'm sorry, does not pay anything back. And what that means, let's just say today's rate was 3%. And that was the par rate, I should say. That means it does not cost anything and it does not pay anything back. Well, for every 8 that you go above that, it actually starts paying money back typically. So if you were at 3 1/4, it might pay back a half, so 0.5%. What I mean by that is it actually gives the customer a credit that they can use to pay some of their closing costs. You can't use it to pay your down payment, but you can use it to pay your closing costs. And this is with all loans. Now, as you go down on the interest rates, let's say you said, actually, I want a little lower than what the par rate is today. I want 2.75. Well, that might cost you a half. And what I mean is 0.5% of the loan amount. So if your loan amount's $200,000, that would be $1,000 is what they would charge you to get a lower interest rate. So it would cost you more money up front, but over the life of the loan, you're gonna save money. And what I tell people to do is, hey, look at how long it takes you to recoup the cost. So if it costs you an additional $1,000 to get that lower rate, and that lower rate is saving you $50 a month in your payment, we'll see how long it takes to recoup that $1,000. And the answer to that is 20 months, which is less than 2 years. And in my opinion, anything that you're recouping in less than 5 years, it makes sense to go ahead and take the lower interest rate. And the reason I say 5 years is because the studies show that people typically are in their house for 5 years on average. So I think it's 5 to 7 years is what they said. So that's the difference between a discount point origination. Origination being, it's just a fee. The lender said, hey, I'm charging this amount of money. And lenders can do that if they want to. But anyway, fees that can never be charged to a veteran: the termite and the pest inspection, a septic inspection, the well inspection, and then any kind of mortgage broker fees. You don't really see mortgage broker fees very often. It's kind of a junk fee, and that's why VA doesn't allow the veteran to pay it. So yeah, that's something that they basically just kind of said, no, we're not going to do that. If you want to charge a junk fee, it's fine, but then you got to get somebody else to pay for it. Hold on one second. Let's see if there's any questions. Okay, so somebody asked about covering a condo with VA loans. There's an approval list. If you're approved on the FHA, it's a very good question, by the way. If you're approved on FHA loan, there's a list that FHA uses for condos. If you're on that list, then you can get approved for that condo is approved for VA also. So if it's not, there is a way to get the condo. There's a process to get the condo through. I've never done a condo VA before. So a lot of it, you kind of know real well what you've experienced firsthand, and then you're just kind of okay on the stuff that you don't know, or that you haven't done, I should say. So it's not that I haven't, it's not that I don't know it. I just haven't seen it in real practice yet. So I haven't actually gone through the process.
Question.
I think, yes, go ahead.
Regarding the condo, I asked that question. So as a realtor, when your client comes and says, I want to buy a condo with a VA loan, my question is, where do you find, because obviously not every condo they're approved for VA loans. So how do you, what is the best way of finding, in other words, a shortcut finding to what is available with the VA loan rather than just going on FMLS and looking for condos?
Yeah, that's a good question. Because obviously you don't want to sit there and entertain a condo that never had a chance of getting what your customer's financed for. Right. Yeah, so typically the condo association should know that. I mean, they should know, because trust me, you wouldn't be the first person that ran that problem. So that is where I always tell people to start. just ask them, say, hey, is this thing an approved FHA condo? And if it's approved FHA, then it's approved VA. If you can't get any traction there, then what I would do is I would actually go to your lender, and the lender that you would typically use, and say, hey, can you look this up for me on the FHA? It's FHA Connection is where the condo approval list is, and they can search it for you. It doesn't take very long. It should be a pretty easy thing. You just have to have access to FHA Connection. I used to have access. I don't know if I do anymore. I had it when I was an underwriter, and then I turned to originator, and they like cut out all my stuff. Apparently, they don't want me underwriting my own loans. Go figure. But okay. Let me go to any other questions. Oh, my screen got real big. No, go back. Exit full screen. Okay. Any other questions? Okay. If you cannot charge the veteran with those fees, and who pays them? And that's a very, very good question. So you just either don't charge them, or the seller has to pay them. Remember, the seller can pay 2% plus closing costs. So the seller's paying them, it's fine. They can still be charged. And we would just need to make sure, the way they do that, anytime there's a seller concession, the closer determines where those fees go under. And if the closer sees that there's a fee there, they'll go ahead and put that underneath the seller concession amount. And if it's not, they'll go ahead and then it's an amount that the seller has to pay. So the seller really is the answer. Also, the lender could pay it. Remember what I said about sometimes you would charge a higher interest rate? I don't know if y'all remember that back in the day, if y'all have been doing this for a long time. Oh, I can't remember what that guy's name was, but it was the biggest no-brainer in the history of Earth. He was always like, quoting like no closing cost loans. Like if you're paying a dime in closing costs, you're getting ripped off. And he sold it like he was just doing this like really, really special thing for people and not charging them, closing costs like these other predatory lenders were. And really all he was doing is he was just upping their interest rate and paying closing costs with their interest rate, which is not necessarily a bad stick. It's a little disingenuous, but he would raise the closing cost, raise the interest rate up by a half. So in essence, they were paying closing costs. They were just paying it in the form of their monthly payment being a little bit higher than what the next lender would do too. So you could do that here. You could raise the interest rate just a little bit and give the credit and use the credit to pay for those fees. That's in essence what's happening there is the lender is paying for it. So. Does that make sense? Okay. Let's look. Let's go back to our. It might be the end of our screen. I think that's it. Is that it? Yep, 103. We have reached the end of this class. So I'm going to real quick go back to the guideline piece of it. Give me 1 second. Can y'all see the are y'all able to see this guideline scene where it says funding fee? Could y'all see that or no? Okay, I'm going to go back to that. Give me 1 second. I think I have to stop sharing and I have to share just that page. Share. Share. Let's go to here. Okay, so now you guys should be able to see that. So when we're in here looking at guidelines, what we do is we go to this little website right here, and it gives us all of the guidelines. It gives us what the funding fee is, and just some really interesting or really good resource to go in and get. Now you do have to have access to this, but there's no password needed. So you don't have to have, it's not like it's like secured access. Now to get the COE, you do have to have access to, but the guidelines are right here. And I try to tell people this for all guidelines. Guidelines are available to the public. They're not just for like, we don't have like super CIA, security clearance to be able to get to guidelines. So if you ever want to go search the VA guidelines, for yourself, and if something just doesn't seem right, search them. Don't just take somebody's word for it. And but it's pretty easy if you want to know. Let's just say they said, "Hey, I want to know if I can use rental income." Well, do Control F, which is just find, and then search into rental income. And bam, there you go. And this is to our point earlier, where all portions of the borrower's income is derived from rental income. Now that would be all portions. Verification of rental property income, one of the following. Document the reserves totaling 3 months. Oh, sorry, obtain the following. So the tax returns not dated previous 2 years, which shows rental income of the property. And let me go down one more page because I'm sure this. The borrower of all the properties, borrowers, there's lien, the property 3 years, cash proceeds. So anyway, it goes through what you need for rental income. And let's just say you want to see what commission income. And you can see verification of commission income obtained by VOE or other written verifications which provide the following. The actual amount of commission paid year to date. And just goes through the list of it. And the end thing there, you say for previous two years, income tax returns signed and dated, plus all applicable schedules for the previous 2 years. So again, there's a lot of information there where you can get to for yourselves, and you don't have to necessarily trust somebody. This is how this information gets skewed and gets spread, is when people instead of just kind of going and getting information for themselves, they just hear it from somebody who heard it from somebody else that heard it from a guy, you know. And in underwriting, this stuff is rampant, by the way. So just because an underwriter says it does not necessarily mean it's true. That's one thing I want to really reiterate to people, that you know, it's not. Go get the information for yourself. So, but that's it. Any other questions? Any other questions? I'm going to put my name and my contact information here real quick in the chat. Oh, I don't want to. Sparkley. Actually, my team number 608 561 1554, and the WB team. So I have a team of people. So I have me, my brother, and then our assistant, the guy I nabbed from my church. He's a young guy, but he generally collects all the documents from the customer whenever once we've done the pre-approvals. But me and my brother do all the loan applications. So that number that I just left you there, that is that's our team number. So if you contact that, it rings all of us, and somebody will answer your call. So it's definitely something that you should be reaching out to me if you have any questions about VA stuff. Because like I said, I love doing VA, and just really overall love helping people. So any other questions before I end this thing?
Just wanted to say you did a wonderful job really taking a semi-dry topic and really, truly, really letting us know what's going on. And I think this is a very, and I'm a veteran, this is a very untapped market. Yeah,
I agree, John. Like I said, let's tap into it. So I got your contact, my friend. I'll be reaching out. So
all right, buddy. Thank you.
Yeah, no problem, guys. Well, everybody have a great day. Again, if you have any questions, give me a call and reach out. And it has been my pleasure to teach this. And yeah, that's all. See you guys.
See ya.
As soon as I figure out how to stop this.
Will we get a handout, a copy? All right. So
yeah, I'm gonna try to get. I'm gonna try to get
our email address.
Yeah, I think you're supposed to put your email address in there, and then your license number into the comment side, and then yeah, that's kind of how you sign up for it. So, but that is all. Thank you all so much.
Okay, because I don't have my license.